If I had to buy something, I would rather buy stocks rather than buy bonds.
I think the investment for AI has to take place now.
AI models are so powerful, driving so much demand, that we do expect them to grow into next year.
What you see going forward, though, from the four hyperscalers is clearly more spending.
The AI race continues.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, the boom is over. Earnings from Nvidia underwhelming, forecasting a deceleration in growth. The tech giant failing to record any sales of its H20 chip to customers in China, as the CFO cautions the plan to pay the White House 15% of its revenue there hasn't been formalized.
So here's the question with NVIDIA's performance. On one hand, you could say it's deceleration from this sort of moonshot that we had seen, and it really raises questions about its valuation. But as you can see from the market reaction, where you see these shares down less than 2% after more than a 35% rally so far this year, a lot of people are shrugging this off as maybe just underestimating how much revenue they could ultimately take from China, and a China story more than some sort of end of the AI boom type of narrative.
China in focus. Morgan Stanley saying this: China remains impossible to forecast.
What you can see from these earnings results is basically how challenging it is to guide when you are dealing with on and off policy out of Washington, D.C. And I think for NVIDIA, it's so delicate, the situation. The downside, only a select number of Chinese firms are able to get those licenses for the H20, but none have been shipped. The upside, Jensen Huang talking about potentially this idea of selling the Blackwell chip, talking about basically lobbying the White House for it. There could be tremendous upside, but at the moment, they are not raking it in. And when it comes to that 15%, Jonathan, subject to litigation, increase our costs, and harm our competitive position and benefit competitors with this kind of arrangement. So it's not all rosy at the moment between the C-suite and the Oval Office.
As Lisa said, the stock is only down by about 2%. The broader market unchanged. This is a change. How dependent are we on the gains from one stock anymore? If you look elsewhere in the equity market, banks at record highs, home builders rallying so far this month, cyclical parts of the equity market holding up.
Yeah, this idea of a broadening out in the rally, and it wasn't necessarily because AI is trickling out into all parts of our economy. It's because, guess what? Suddenly people are counting on rates going lower, and they're counting on a more accommodative stance from Federal Reserve officials. And given that, a lot of people are looking at small caps. We saw this particularly late last week. They're looking at the rest of the market, and they're saying, okay, we are ready for a boom. And that seems to be reflected in the market.
It's good to have you back, Bramo.
Thank you. It's
you
great to be
rested?
Here. Completely rested from the Bears. I guess that the Bears did not get the dominance over this. And I will say I had to come back. It was NVIDIA. It was a 5-year auction yesterday that was tepid. I mean, I had to clearly get back on my feet.
Just brought you back in.
I mean, it was just absolutely compelling.
It's good to see you. Coming up this hour, more from Bramo. Plus, Keith Lerner of Truist. The stocks look for a third day of gains. Ives of Wedbush breaking down results from Nvidia. And Earl Davis of BMO on the risk building in the bond market. We begin this hour with stocks pushing higher after shrugging off a lukewarm forecast from Nvidia. Keith Lerner, the chief market strategist at Truist, writing the following: we still like tech longer term, but the rubber band became stretched too far and in need of a digestion period. This will likely lead to some further rotation. Keith joins us now for more. Keith, welcome to the programme, buddy. It's good to catch up. Just how dependent are we on this single name? Based on the price action this morning, maybe not that much.
Yeah, well, great to be with you on NVIDIA Day. For the broad-based market, I mean, it's still somewhat important since it's 8% and it's a big driver of overall tech, which is a big driver of the overall market. But I think, you know, so far, if you're bullish on this market, you got to be somewhat happy that the market's relatively flat. And really, NVIDIA is trading back to where it was last Friday. And, you know, this market is a lot about expectations, right? Markets are always about expectations. We talk about that rubber band. From the lows in April, you know, the S&P is up 30%. The tech sector is up about 50%, and NVIDIA was up almost 100%. So in our view, you know, expectations are just still somewhat elevated, and it needs a digestion period. Longer term, we're still bullish on technology. We're still bullish on the AI theme. But I do think, as we're seeing this morning, you take a little bit out of some of these big cap stocks into, like, say, small caps, which are a bit up this morning a bit. It doesn't take much. I mean, we all know that NVIDIA by itself is bigger than the entire small cap index.
Well, let's talk about what's happening with the small caps, Keith. We're seeing a pickup. We're seeing a pickup in the home builders so far in August. Bank stocks at all-time highs. Keith, we're expecting a shift in the rate regime. Do you think that shift in the rate regime leads to a shift in leadership?
Yes, I think it's one component of it. Again, I want to be clear. Longer term, we still think the dominant theme remains with AI, but on a shorter term basis, the next month, next few months, I think there's some rotation that will likely continue. So it's a couple fold, Jonathan. One is the rate cuts, that's true. But two, the starting point is we have the most extreme underperformance for small caps relative to large caps since 2000. So that's the setup going into this, even with last Friday's move. On top of that, what's changed more recently in our work, the forward earning estimates for the small cap index are rising at the fastest pace that we've seen for some time. So that's a positive. That's different than what we saw last year. And where's that coming from? Well, it's coming from also tech and communications within that sector, but we're also seeing industrials and then financials, which will benefit from the lower rates, the steeper curve, and also a pickup in M&A and deregulation as well. And then positioning is still somewhat offsides. Earlier, a few months ago, we saw the greatest outflows out of small caps that we've seen over the last decade. So I think you put all that together and you throw on top the one big beautiful bill, which has some incentives for more leveraged companies. It provides a setup for small caps to do better here, even on a relative basis.
A lot to unpack there. Let's just start on the rate story. Does 50 basis points of rate cuts really get that done, given that there still is potentially a longer way to go based on current analyst estimates to get to neutral?
Well, I think it's the path of over the next, say, 12 to 18 months. But no, I mean, a quarter point or 50 basis points by itself isn't going to dramatically change the game. I think it's on the margin. It's a positive, but it's not the only factor that matters for small caps. Everything else I laid out as far as, the one big beautiful bill that I think was underappreciated about the positive impact on tax rates for small caps, the pickup in M&A, even. We're not there yet, Lisa, but a little bit more clarity on tariffs is helpful. And then the other thing for small caps, too, you need to tend to see better economic growth. As we move into next year, we're around 1.3% for the economic growth this year. We're expecting that to move up closer towards 2% next year. So it's not gangbusters. But again, all these things are on the margin at a time where position is still relatively light. And it doesn't take much of a rotation out of these big cap names to move these smaller cap index.
One reason why a lot of people are skeptical of that argument, Keith, is that there's been an underperformance from this sector for a very long time. It's sort of the perennial underperformer, and everyone keeps hoping that means that it's cheap, and it ends up just being undervalued for a reason. A lot of people have argued bigger companies can adapt to whatever changes there are in the tariff regime, in some of the regulatory regime, than smaller companies, and we've seen them gain share. How do you understand how to evaluate that, to understand whether something is cheap, given this sort of structural change between big companies and small companies?
Yeah, well, we've been making the same arguments on large caps and why we've been overweight and still prefer them. But how do we make that decision? Well, going back to that kind of weight of the evidence approach, cheapness is not a catalyst. I mean, people have been saying that small caps are cheap every single year and they haven't moved. I think the difference this time that we're seeing is earnings. Earnings for a small cap, and I'm talking about the S&P 600, are still below where they were in 2021. What we've seen more recently is those earning trends start to move forward. So if we look at the condition is still we're oversold as far as performance, we're seeing the earnings move up. And then you have, again, a little bit of deregulation, a little bit of lower rate cuts, a little bit of fiscal stimulus. And then on top of that, we look at the technical trends. The technical trends are improving. We have the index is in a nice uptrend, and on a relative basis, we're seeing improved performance. So you put that all together, and that leads us to say, hey, the outlook has brightened here in the near term for small caps.
Keith, do you basically think the fiscal uptrend with the one big beautiful bill, the deregulation, outweighs this potential hit we can see on small caps in the next 6 to 12 months when it comes to the settling of tariff rates?
I think this is, it's still an issue, but part of the reason why small caps have underperformed by the most, we've seen since 2000, that's on a 3-year basis, or even over the last year, they're still underperforming by about 10%, is because of this uncertainty around tariffs. Now, the question becomes, is that tariff outlook going to become worse, or do we know what it is, or do we have a better kind of starting point today that at least companies know how to adjust better? So listen, for all those reasons, large caps can adjust better, but at some point saying what is priced in relative to expectations, what we're seeing in the large cap space is, at least on a short-term basis, a lot of good news is priced in, probably needs a digestion phase, where, again, you move a 1% move in NVIDIA equates to, more than the biggest stock in the small cap index. So it's also about positioning as well, and I want to distinguish maybe a shorter term, several months versus the long-term trends, which we think is still with AI and tech.
Well, when it comes within the small caps, what industries are best prepared to weather the storm?
Well, I think, if you look about the small cap indexes, a lot of times it's a story about sectors. And the biggest sectors in small caps are financials and industrials. And what they have in common is they do benefit from some of this stimulus. On the financial side, they benefit from lower rates, the pickup in M&A, and a steeper curve. The industrial side benefits for some of the incentives that we're seeing in that one big beautiful bill, and they're also backdoor AI plays as well. So, I mean, those if you're going to be positive on the small cap area, you have to be somewhat positive on financials and industrials, because the small caps have about half the allocation to tech relative to large caps, and we are positive on those, like I said, financials and industrials.
Hey, Keith, it's got to catch up. Keith Lerner there of Truist, with the Russell up by 0.6% of the small caps outperforming once again this morning. It's interesting, the market's telling you one thing and the data is telling you something completely different. The market's telling you that we're looking at a re-acceleration in growth potentially. Look at the data from the conference board earlier this week. The shares of consumers that said jobs were hard to get rose for a second month to the highest since 2021. Last week, on house purchases from Redfin, home purchase contracts in the US cancelled at a record rate for the month of July. Something amiss here. What's right at the moment?
You've been talking about this idea of, can we price in the recovery before the downturn has happened? Can we bake in the idea of rate cuts forming some sort of reacceleration before we even get the weakness that the Fed would ultimately be responding to? That's the conundrum. Are we accurately understanding just how much rate cuts can stave off the weakness that we're seeing in the data that will then lead to a reacceleration that hasn't really started yet? If your mind is somewhat numb, well, just go buy stocks, evidently.
My head's spinning, and apparently people are still buying stocks.
Exactly.
Equities at a close yesterday, all-time highs on the S&P 500 this morning. Little change. With an update on stories worldwide with your Bloomberg brief, here's Yahara Anand. Hey, Yahara.
Hi, John. We're seeing NVIDIA shares falling nearly 2% in the pre-market. The chip maker gave a tepid revenue forecast for the current period, signaling that growth is decelerating after a staggering 2-year boom in AI spending. NVIDIA says it expects sales to be roughly $54 billion in the third quarter. That is in line with the average estimate on Wall Street. Meanwhile, the Mexican government is planning to increase tariffs on China, fulfilling a long-standing demand from President Trump. Sources telling us here at Bloomberg that the tariff hikes are expected for imports, including cars and textiles, as Mexico aims to shelter domestic manufacturers from subsidized Chinese competition. And there's been another shake-up within the Trump administration. CDC Director Suzanne Monarez was fired just weeks into her tenure. Her attorneys say Health Secretary Robert F. Kennedy Jr. targeted her because she refused to, quote, rubber stamp unscientific, reckless directives. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the programme, the boom is over.
It's actually been about almost 5 quarters since the last time we saw a significant beat and raise from NVIDIA. I mean, the narrative, I think, is still largely very positive, but we just didn't quite see the, this beat and raise that the market's been looking for.
That conversation up next with Dan Ives of Wedbush, live from New York City this morning. Good morning. Live from New York City this morning. Good morning. Bramo's back, so let's do this. The bond market in Europe. Check this out. Germany, France, and Italy. France trading super tight to Italy now. And the spread between Germany and France in the last 24 hours opening up to a spread of about 80 basis points. We're talking about that spread potentially getting into triple digits. The French want to get through, and when I say the French, I mean the Prime Minister, wants to get through 44 billion euros worth of spending cuts and tax hikes. And once again, it's proving rather difficult.
Yeah, which means maybe even the collapse of the French government. You're also seeing, and I know that this will get you and Annmarie both excited, this idea that Italy is almost on par from an implied creditworthiness as France, with 10-year yields now trading just 10 basis points under. the similar denomination over in Italy. That is the tightest since 2003, at a time where there's a real question about how they deal with what their current premier says is just an absolutely overwhelming debt burden.
You know, outside of the bond market, it's interesting. Euro weakness. Bank stocks, the big winner in Europe of the year so far, down 5% so far this week. Just wonder to what extent this starts to infect the overall let's get long Europe, let's look for that outperformance over the US story.
Yeah, we've been seeing a little bit of a softening, at least in the stands today, when you see some of the equity rebound, particularly in the likes of France. But you're right. People who talk about U.S. political dysfunction need to look elsewhere and look at the yield, particularly the 30-year yield across the world, rising to a significant degree, because it's not just a U.S. political dysfunction story. It is a global developed market political dysfunction story, and you're seeing that very much expressed in the bond market.
That's the latest on the continent. Just to reinforce what Lisa said, this is a story that you're seeing play out worldwide, not just stateside. Stateside, the main event, this stock right here, Nvidia in the pre-market, negative by 1.8%. Some pushback from the analyst community. 72 buys, 7 holds, just the 1 sell. A very constructive tone from analysts overnight as well. Citi saying we continue to see upside in data center sales with or without China. Hargreaves Lansdown out of the UK, Lisa. Smart investors will look through the noise.
And this is the reason why. Nvidia is on course for annual sales of $200 billion. That number expected to surpass $300 billion by 2028, which means that they're getting about a third of the entire revenue for the entire chip industry. This isn't exactly a stock that you really want to short. And that's basically what they're saying.
Stock is down by 1.7% in early trading. Under surveillance this morning. The boom is over.
In a word, we just didn't see a beat and raise. And it's actually been about almost 5 quarters since the last time we saw a significant beat and raise from NVIDIA. I mean, the narrative, I think, it's still largely very positive, but we just didn't quite see the, this beat and raise that the market's been looking for. I mean, I think, we have continued to see that demand is strong, but, the market's gotten so used to them, or hope to see for them to beat numbers, and they haven't.
Here's the latest this morning. Nvidia forecasting a deceleration in growth, signaling the 2-year AI spending boom may be coming to an end. Dan Ives, the global head of tech research at Wedbush, writing, we view any decline in Nvidia stock to be a clear buying opportunity, as it remains the only game in town fueling this 4th industrial revolution. Dan joins us now for more. Dan, you've seen the headlines. The boom is over. What's the pushback this morning?
I think the boom's just starting. I mean, if you look at these numbers, especially when you factor in what China is going to be, I mean, Jensen talked about 50 billion, 50% type growth number. This just shows the next stage of adoption is actually just starting. I think this stock is green today.
By the end of the day, Dan, that's what you're saying. You think that by the end of the day, people will realize, come around to your point of view, that actually what the disappointment was a non-inclusion of any China sales, but a real robust growth elsewhere. Is that your argument?
You just exactly summarized it, because the reality is that when you look at data center and then you actually factor in what China is going to be, when you look at 2 to 5 billion and you look at the acceleration in the next few quarters, I mean, there's no region that's not accelerating. And now in China, with the pay for play model back in, you're talking about could be an incremental 20, 25, 30 billion. That's why it comes down to the godfather of AI, Jensen, NVIDIA, continue to dominate this. And I think this is just a further validation. Tech stocks go higher.
Dan, I feel like we should do a show, Where in the World is Dan Ives of Wedbush, because you're always somewhere different. And this morning, it looks like you're down under in Sydney. And I'm curious about the rest of the world. It's actually really telling that you've been traveling the world, because outside of China, NVIDIA's growth has been tremendous. And we've seen a real increase, particularly in other Asian countries. How much does that give you that extra bullish push that even if it's not China, you are seeing the rest of the world rush to adopt as much as they can of NVIDIA before maybe some of the policies change?
Yeah, look, and I think you see that when you look at Middle East. I mean, Middle East is a perfect example where they're just continuing to just massively build that out, when it comes to Saudi, UAE. Look, the reality is that they're years ahead of any other chip player. I mean, you look at everything happened from a Huawei perspective. They've narrowed the gap, but the reality is that every Chinese big tech player wants NVIDIA chips. And I think what you start to now realize is that you talk about a third of that overall revenue going to NVIDIA. This is trillions that's going to be playing out. That's why I believe there's a $5 trillion market cap, either by year end or early 26.
But Dan, the China policy is subject to change on the U.S. side. And also we have seen in the past Beijing telling firms not to buy NVIDIA chips. Can this company continue to grow the way you envision if, say, China was taken out of the play?
Yeah, look, there's no doubt. China continues to be, that's the golden goose for Jensen and NVIDIA. But that's also why, look, Jensen, 10% politician, 90% CEO. And when you think about the China market, but also Beijing telling Chinese companies, big tech, not to buy NVIDIA chips, that's like telling a kid, oh, don't eat the candy. The reality is they want NVIDIA chips. They don't want to have a third, fourth rate chip. And that's why Jensen knows it. And they're going to continue to kind of play this policy. And I think we sit here 6, 9, 12 months from now. China's a $50 billion annual market for them.
Jensen Huang last night said they keep advocating on the sensibility of and importance of American tech companies to lead and win the AI race. Basically, we keep lobbying the American government when it comes to Blackwell. Do you think at some point they'll be able to sell those chips into China?
Pay for play model, right? I mean, maybe that 15% goes to 25%. Look, because Jensen understands that what they can sell, that gives Huawei and China that much more power. And I think in this AI arms race between the US and China, biggest poker chip on the table continues to be NVIDIA. And I think that's the reality. There's no one that has more influence when it comes to AI, relative to Trump than Jensen. I mean, he's become really, I think, a big strategic advisor for Trump administration when it comes to AI.
Dan, nobody's saying the growth story is going away. We don't think this is going X growth. No one's suggesting that. We're going to see healthy double-digit growth figures based on what we heard from the company overnight. What they are suggesting is that the level of growth is going to change. And perhaps we need to reassess our view of this company with that in mind. Dan, how have you changed your view as growth decelerates, just by definition?
Yeah. I mean, look, my view is that as you start to actually go into physical AI world and you go into autonomous, you go into robotics, you look at the next few years, I could argue Street's underestimating numbers 25, 30% next few years. So I think as this actually plays out, my view is like NVIDIA is undervalued relative to where this is all going. And we're only in, like I've talked about, the AI party was 9 p.m. It's now 10:15 p.m. That party goes to 4 a.m. And Jensen's going to be out there on the dance floor because he and NVIDIA are leading the AI revolution along with the hyperscalers and Palantir.
What's become clear, though, from the earnings of the likes of Microsoft and Google or Alphabet is that there is some pushback when it comes to the investor community about how much some of these companies are spending. And it needs to broaden out in a significant way. And if it does, that raises questions about how much NVIDIA has to steal market share from other players. Who's going to be the biggest loser as NVIDIA continues and charts its path over complete dominance of this industry?
Yeah, look, losers are clearly Intel, right? I mean, despite obviously what we see with U.S. government and, and obviously SoftBank, I mean, I just think there's a better chance of me playing Ryder Cup Bethpage than Intel gaining share. And I think that's part of the issue is that AMD is going to gain share. NVIDIA is going to gain share. You're clearly, Broadcom and others. But I think it's a have and a have-nots. That's going to continue to play out. But you look at last night's quarter, along with what we've seen from earnings, as a bull, you feel really good in terms of the validation story for AI.
Dan, before you go, should Keegan Bradley have chosen himself?
Look, I think he could have chosen himself. It was obviously maybe a good decision for him, but I think ultimately U.S. wins that Ryder Cup Bethpage.
Oh, we'll see what happens. Dan Ives, thank you, sir. Dan Ives of Wedbush, 8:24 p.m., 8:25 now. It's Sydney, Australia. Dan Ives should be on the dance floor in a few hours' time.
He'll still be there.
He's dressed for it.
You just had your golf conversation. I'm so
and I squeezed it in.
You managed to get some golf with someone who really relates.
I wasn't expecting it to happen later on in the programme. All right, that was my chance.
That was your chance. You had to
Made
take
it happen. I think the European team gets announced on September 1st. Okay. All right, more on that still to come. Not today. For like next month or something. Up next, Tobin Marcus of Wolfe Research. There was a time, not too long ago, when NVIDIA would come out with underwhelming results and you'd imagine this market would collapse. I say collapse, but down at least 1% on the S&P Not seeing that this morning. Totally unchanged on the S&P 500, even the Nasdaq, where Nvidia makes up 10% of the index on the Nasdaq 100. That benchmark is totally unchanged. So far this morning, the equity market going nowhere. Outperformance on the Russell, up by 0.6%. Seen that a few times in the past few weeks off the back of the rate discussion. So let's have the rate discussion. In the bond market, 2-year, 10-year, 30-year. Compare the extreme end of the curve, the front end and the long end. 2s versus 30s, the steepest going back to November 21 in yesterday's session. Unwinding some of that this morning with the front end higher by a basis point and the very long end lower by a basis point. But Bramo, as you know, that's been a story over the last week.
A lot of people have been attributing this to this question of Fed independence and will the Fed essentially cut rates substantially, even in the face of inflation, allowing inflation expectations to pick up in a significant way. When you take a look at break-even rates, it sort of throws some questions around that story because you're not seeing them break out. You're not seeing inflation expectations absolutely surge, and this seems to be a global story. So it goes to a real question. Is this a question of supply and demand, of just too much long-term debt that needs to get sold to finance deficits around the world, and too little demand at a time of increasingly skeptical investors?
Yes, yes, and yes. And worldwide, in France, in the UK, in Japan, and not just the US, and we have to keep going back to that story. We're seeing this all over the place.
And all over the place, we're seeing renewed concerns about a deficit and, frankly, governments that are crumbling over the need to actually finance it and not just keep borrowing. And it raises a question about the resilience of developed market democracies to come together at a time of increasing polarization, because that is a story globally, not just in the United States.
We'll get to France in just a moment. For the United States, 2 hours away, 8:30 Eastern time, you'll get jobless claims. That's the next stop for this market on the data front. With 3 hours until the opening bell, let's get you some single names, some morning movers. We can do that with Danny Berger for more. Hey, Danny.
Hey, John. Well, we did get through one risk event, and that was NVIDIA earnings yesterday. You pointed out that the NASDAQ isn't moving much. NVIDIA, for its sake, is down less than 2%. Post-market yesterday was down 3%, so even some of that has come back. It was a tepid forecast, $54 billion worth of revenue. Some of the estimates were as high as $60 billion. But you heard from Dan Ives, who was just speaking to you, thinking that this stock would end green by the end of the day. Jensen Huang talking that there's still a lot of demand there. The hyperscalers are still spending. So maybe why you're not seeing as much pessimism. Where you are seeing pessimism, though, is CrowdStrike. Those shares are down 3%. They also reported after the bell yesterday. It was a disappointing quarter for CrowdStrike. It would appear that, remember that whole thing a year ago when CrowdStrike went down and brought down with it a lot of airlines and other things? That's still having lingering impact and lingering costs, so that affecting their quarter. The real winner, though, from the earnings last night was Snowflake. This is the software company. They gave a forecast that was very strong, stronger than expectations. There had been a concern with this company that because of an economic slowing, that less customers would be buying their products, and at the same time, AI coming into the force would also make them less relevant. That didn't happen. Again, strong figures, so those shares up nearly 14%, John.
Danny, appreciate the update. More from Danny in the next hour. On a radar this morning, NVIDIA CEO Jensen Huang saying it's a real possibility the company brings its advanced Blackwell chip to China. The company currently limited to selling the less advanced H20 chip to China, where it owes the US a 15% cut of sales. Elsewhere, a letter from Chinese President Xi to his Indian counterpart written in the run-up to President Trump's Liberation Day tariffs now coming to light. The letter expressing concerns over the US and urging the countries to test the waters on improving ties. And finally, as promised, the French Prime Minister, François Bayrou, ramping up efforts to hold together his government as the country's parliament pushes for his resignation. The French leader warning against holding snap elections and saying he'll negotiate directly with lawmakers.
Yeah, and he has until September 8th when they have that no confidence vote potentially. And this real question of how do you bring together two sides that are increasingly polarized? This is what I was hinting at earlier. That's very much what he's saying. We can't govern. So you get rid of me as a premier. Who are you going to put in next? Are they going to be able to handle this so much better? And we've got this crippling debt load that we've got to deal with. This is the reason why long-term yields around the world are rising, because it is not a problem that's isolated to any one developed market democracy.
And it's deja vu. If they put someone else new in, they're going to deal with these same exact problems. How to get a budget through when you have a very polarized parliament. Michel Barnier, who he took over for, similar situation we saw, lasted only 90 days. This new prime minister is in the chair for 9 months. This basically means we are likely going to see a collapse of the French government. And this is going to be very challenging for Emmanuel Macron.
You're going to see this problem on repeat. We talked about this earlier this week. I think we've really got to think this through. They will not vote for this stuff until the alternative is worse. I said that repeatedly earlier this week. So what do I mean by that? They won't vote for this stuff until the market consequences are worse. and this is nothing, to get the kind of reforms, the kind of cuts to spending and tax hikes that a lot of people think the likes of the French government need to do, to get those politicians on board, for that to be politically palatable for them, they need to prove that the alternative is worse. And we're not there yet. And that's the worrying thing for me. To get better, things need to get worse. That's a problem.
It seems like governments around the world are playing chicken with bond markets.
Big time.
And everyone's saying bond markets are the ultimate adult in the room. And they have to come and discipline governments around the world. And they don't really want to do it yet because the yield is still appealing on some kind of level. So to your point, what kind of sell-off do you need to see? What kind of yield spike do you need to see before there's some kind of step toward improvement? It's a great question. And right now, it's one that markets want to just ignore, keep buying, and go back to the beach.
It's not 350 on French 10s. Let's put it that way. I like the beach line.
Yeah.
Very European.
Yeah, you want to go there.
That works.
Maybe this weekend.
Why not? Yields lower in France by a basis point. Stop distracting us. This holiday mood, I feel it, those vacation vibes.
Yeah. You want to squelch it? You're like taking your thumb.
Good. How long's this going to last?
Well, maybe another. Well, I'm off again tomorrow. It's
there
great.
You go. Me too. Me too. Long weekend. Very European. Okay. Let's turn to the Federal Reserve. A lawsuit from Fed Governor Lisa Cook looming as President Trump moves to fire her from her position. The NEC Director, Kevin Hassett, calling on Cook to take leave while the case plays out. For the latest, here's Tyler Kendall with more. Morning, Tyler.
Hey, John. Good morning. Well, Fed Governor Lisa Cook could file her lawsuit as soon as today, challenging President Trump's efforts to oust her. Now, it is widely expected that Cook is going to seek something known as a preliminary injunction, which would decide whether or not she's able to remain in her seat, not to mention vote in the September meeting, while the broader legal issue of her case plays out in courts. And I had the chance to catch up with one legal expert who told me that it is this injunction request to really pay attention to, because that is going to set the table for at least the next few months. Now, as you well know, the president says he has sufficient cause to fire Cook over these allegations of mortgage fraud, but no formal charges have been filed. And perhaps we got a little bit more insight into how the White House is thinking about this legal case yesterday when senior trade advisor Peter Navarro joined Bloomberg Television and said that the White House is prepared to argue that it does not matter that these allegations have to do with Cook's private conduct and not her time at the Federal Reserve. That is going to be one of the big questions that the courts have to decide, because, John, we know that President Trump is looking to get to that majority on the Fed board of governors. He said it himself that he's looking for that 4 out of 7 seats to be Trump appointees, but we are not there yet. A person familiar, though, does tell Bloomberg News that the Senate Banking Committee is prepared to kick it into high gear and hold a confirmation hearing next week for Stephen Myron, who's been appointed or nominated for that temporary board seat when it comes to the Fed. If this were to happen by that September 17th date, John, that would be considered pretty fast movement by the U.S. Senate.
Tyler Kendall with the latest. More from Tyler in the next hour. Tyler, thank you. Joining us now is Tobin Marcus, the head of U.S. politics and policy at Wolfe Research. Tobin, welcome back to the programme. Where do you think ultimately this one is going?
Thanks. Good to be here. My guess would be that at the end of the day, the Supreme Court will side with President Trump and uphold the firing of Fed Governor Cook. I think at the lower court level, I do think she will get a preliminary injunction. The district court in D.C. has tended to side with independent agency commissioners who've been fired in these disputed cases. It's a fairly Democratic-leaning jurisdiction. I think that'll get held up at the circuit court level. But when this gets to the Supreme Court, I think that the center-right bloc in the court, Roberts, Kavanaugh, and Barrett, who are going to be decisive here, I just think that they're going to be quite reluctant about second-guessing what constitutes cause for the president, given their investment in sort of a strong unitary executive, given the lack of specificity in the statute about cause. The Federal Reserve Act doesn't say anything about cause. It doesn't specify what constitutes cause, and it certainly doesn't call for a specific set of procedural guardrails around that. So, I think it's despite their protectiveness of the Fed, which we did see in that Trump versus Wilcox decision, I think they'll be reluctant to second guess him.
Tobin, when it comes to that decision, though, in May, they signaled that the Fed is inoculated. It is a quasi-private entity. Why would they almost do a reversal?
So they signaled that the Fed is carved out from their invalidation of the for-cause protections for other independent agencies. So what that decision in May said was, the requirements that you can only fire independent agency commissioners for cause everywhere except the Fed are not good law. Even though that's in the statute, we're going to say you can fire them whether you have cause or not. and that's held up at the FTC and the NLRB and all these other alphabet soup independent agencies. The Fed, they said, is sort of, it has a special and distinctive history. This is a basically totally ad hoc legal distinction they drew, I think, basically because they're concerned about the Fed more so than they are about agencies like the FTC. But that was about whether or not you need cause. It didn't say anything about what cause is. And so I think when you get into that latter question, that's where looking over the president's shoulder and kind of micromanaging the executive from the judiciary is something that is kind of counter to a lot of what the Roberts Court has tried to do over the past few years.
But taking a step back, there's been no formal investigation. She hasn't been charged, let alone convicted. Does that make it that much more difficult for the Supreme Court?
Yeah, I mean, it weighs on one side of the ledger. I think those are reasons why you might think that cause does not exist here. But again, there's nothing in the statute that requires any of that. So, I mean, reading across from how kind of four-clause provisions in private sector contracts have sometimes been adjudicated, I think you can make an argument that you do need something, you need some sort of formal determination, you need some due process, but that's not written into the statute anywhere. And so I think kind of coloring outside the lines of the black letter of the law is something that they will be reluctant to do. I do think it could go either way. I think this is a close call. It's legally novel. There's not a lot of clear precedents. We haven't adjudicated a lot of cases like this in the past. But my guess would be at the end of the day, this particular court is not going to want to go there.
Tobin, it seems like the analyst community is talking about the loss of Fed independence when it comes to this case. It looks like the markets don't care at all. It looks like the markets have basically shrugged this off and said it's a non-story at this point. It really matters who comes in, what they do, what the response function is should inflation start to pick up. Why is there such a dissonance? Who's right?
Yeah, it's been a really interesting reaction or lack of reaction from the market. So, I mean, I will say the movements when Trump announced Cook's firing were not dramatic, but they did point in the direction you'd expect. You were talking earlier on the program about the long end of the curve remaining stickily high. I think that's been notable even before this story about independence, just as expectations for policy rate cuts at the front end have gotten priced in. We haven't really seen the long end fall, especially the 30-year. So to some extent, like those concerns about whether or not we really do have inflation managed were already kind of baked in. The dovish pivot is already baked in, both based on the chair transition and based on Powell's messaging at Jackson Hole. And then I think that to the extent we do see a change here, from like even in the Cook firing case, it's months down the road, because I do think that you will get a preliminary injunction early on, and there's at least some question as to whether this will stick at all. So I think between the fact that this may not hold up and the fact that it's kind of pointing in the same direction as a set of less extraordinary policy shifts that were already underway, I think that's kind of why we're not seeing a bigger market reaction. But I agree. It's certainly an interesting non-response.
It's messy all round, that's for sure. Apart from in the market. Tobin Marcus there of Wolfe Research. Tobin, appreciate it. Thank you, sir. I found this situation really bizarre over the last week. I understand why the establishment view and the conversation is suffocated by worries about Fed independence. I get all of that. But at the same time, we're almost ignoring what underpins all of this. Real allegations of mortgage fraud, which should be very simple to clean up one way or the other. And I've been surprised in the last couple of days, and maybe we need to give it some more time, and we should give space for due process, of course, that this hasn't been addressed very clearly. Go out and say this happened or it didn't happen. And if you believe it did on the government side of things, open up the investigation, which hasn't happened either. And that's the thing that I'm focused on. More than just can the president fire a Fed governor or not. Let's talk about why this came about. Can we clear that up or not? And why is it taking so long? That's where my attention is.
Yeah, and that's the reason why the Fed has said we'll abide by whatever the court's decision is on this case. A lot of people shrugging this off as it's noise, and frankly, we have seen a lot of noise this year, and the more we look through it, the better. At the same time, there are some real questions here. Another question is, what is the reaction function for any incoming new Fed member if there is some sort of increase in inflation, right? Is there a reaction, or is there going to be some sort of yield curve control? All of these questions leave people in sort of a somnolent state, and that's what we see this morning.
Bond yields this morning down about a basis point, a 30-year at 491. Let's get you an update on stories worldwide with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. White House trade advisor Peter Navarro is pressuring India to halt its purchases of Russian oil. In an interview here on Bloomberg, Navarro accused New Delhi of funding the Kremlin's campaign in Ukraine and even calling the conflict Modi's war. The U.S. has doubled tariffs on India to 50% this week in an effort to secure concessions on trade and pressure Russia. Meanwhile, Mercedes-Benz is urging U.S. and EU officials to quickly follow through on their trade deal to lower auto tariffs, as it says manufacturers are being squeezed by the ongoing duties. European automakers still face a 27.5% tariff on vehicles to the U.S., with the rate set to fall to 15% once the EU, as we've reported, removes levies on U.S. industrial goods. And things got tense on the court at the U.S. Open, with American Taylor Townsend telling her opponent, Jelena Ostapenko, she has no class. The heated exchange, which you can see there, happened yesterday right after Townsend won their second round match. Ostapenko claiming Townsend disrespected her when she didn't say sorry about a net ball in a deciding moment of the match. That's your Bloomberg Brief. John?
Nothing beats Medvedev for scenes at the US Open so far, but this has been fiery, hasn't it?
Yeah, well, I mean, a little bit of drama. This idea of the right etiquette. You say sorry if there's a net ball. I never knew that.
You're meant to.
You really?
Like, hold up your hand, yeah.
Really? And if you don't hold up your hand,
well,
then
I mean,
you start,
sure.
words fly, fists fly,
I don't know about fists. That'd be an interesting thing. I'd
Tennis
stay up to watch more US Open tennis if that kind of thing happened.
If you want drama, go to the Central Park tennis courts on 96.
Are they smashing rackets too?
100%, without a doubt.
8-year-olds beating each other up
100%.
because no one apologized.
Oh, it is great for drama.
Up next on the program, questioning Fed independence.
You've got the long end, which is being confronted by the fiscal situation, being confronted by questions around Fed independence. So I do think the steepener trade makes sense. I have got more confidence in owning shorter dated intermediate bonds rather than the long end.
Up next, Earl Davis of BMO. Live from New York City, welcome to the program. Equity futures on the S&P unchanged, slightly softer on the Nasdaq 100, down by not even 1/10%, even with some underwhelming forecasts coming out of Nvidia. The outperformance this morning actually on the Russell 2000 up by 0.4%. Under surveillance this morning, questioning Fed independence.
Yields still look elevated versus where they've been. It does feel like we're in an environment where owning bonds makes sense. You've got the long end, which is being confronted by the fiscal situation, being confronted by questions around Fed independence. So I do think the steepener trade makes sense. I have got more confidence in owning shorter dated intermediate bonds rather than the long end. And I think that's not just a US phenomenon, that is a global phenomenon.
So here's the latest this morning. The long end of the yield curve in focus as President Trump's attack on the Fed raises questions about the central bank's independence. Earl Davis, the head of fixed income at BMO Asset Management, writes in the following: we prefer being outright short 30-year duration as the global tailwinds are pointing towards higher bond yields. Earl joins us now for more. Welcome to the programme, sir. I'm pleased you picked up on the global theme. What is it about what's happening, developing globally, that's leaving the 30-year, the long end of the yield curve, looking like it's in a weak spot at the moment?
Yeah, there's two things that are doing that. One is increasing fiscal spending, and that's driven a lot by defense. And the other one is unsustainable global tax policies, maybe not in the U.S., but in France. That's exactly why the confidence vote is coming up. And we have the same thing in UK. So all these things are adding a lot of duration risk, a lot of risk that people need to premia from, a risk premia, additional yield to own.
Which is interesting, Earl, because one thing that it's not necessarily is a market increase in inflation expectations. I was looking at 30-year break-evens, at least in the United States. They haven't really gone out of this range. They're at 2.3%. It's not that people expect runaway inflation. So is it this expectation that a number of developed market economies are going to trade, I don't want to say more like emerging markets going forward, but there's going to be a greater question of doubt of their ability or willingness to pay in a way that this world has not reckoned with before?
No, I wouldn't agree with that. I would still think inflation is very, very important to the market. But I've been in the market 30 years, and one thing that I've come to a conclusion on is that the market only focuses on one thing at a time. And inflation is one of the 5 things it could focus on: the fiscal, the Fed independence, the data releases. And right now, because the market can only focus on one thing at a time, it's not inflation right now. And the reason is we haven't seen the tariff flow through or that come through. My expectation is that inflation will be a story of 2026, but it's just not a story for 2025 or the balance of 2025.
Earl, does it make you nervous to outright short 30-year bonds at a time when you're getting 4.9% carry? And potentially this is getting to be a crowded trade trade as one potential offset to some of the anxieties out there about Fed independence and inflation?
No, not at all. Not at all. And this is the beauty of being a fixed income active manager. There's actually math involved in it. And to offset, call it 5% carry, a fixed income 30-year bond has a 20-year duration. That means you only need like a 30 basis point move and your mark to market will be more than 5%. So 30 basis point move is well within the possibility. I think it'll be choppy until we get through 510, just a lot because of, like you said, that 5% yield it's a shiny thing. But, the key as a fixed income active manager is not to get distracted by all the shiny things.
Well, Earl, you've been in the market for 30 years. Are you surprised that the market is not really trading off this idea of this potential threat to the independence of the Federal Reserve?
No, not at all. And the reason why I'm not is basically trading 101. When I have a trainee come on the desk, I said there's two things you look at the market to determine where yields are going to go, directly and then indirectly. The basic things are monetary policy, so Fed, what the Fed does, and the other one's fiscal policy. So all that's going to happen with Fed independence, if it changes, is more of the weight's going to go to fiscal policy than monetary policy. But there obviously will still be a weight with monetary policy. People are anticipating lower rates, given what fiscal is doing. So no, I'm not worried about that at all. The Fed wasn't created as an independent body. It became independent during its lifespan. So the regime is just going to revert to where it was. So one of the key things, it doesn't matter what your end state is, and you could talk about anything for this. What matters to the market's the delta, how fast you get there. And I believe that's what's being reflected in the market. That's what's being reflected in the headlines. That's what's being reflected in the yield, is that this change from independence to less independence, it's happening very rapidly and faster than people thought. So I think that's what the focus is on now. But the end state, it'll still be business as usual from our perspective.
Oh, got about 40 seconds. I really wanted to squeeze in this question. It's on tariffs. When tariffs were first introduced, it was actually negative for treasuries. Yields rose. Over the last few months, we've been focusing on how much revenue those tariffs have been raising, and people have been making the case that's supportive of fixed income. If these tariffs fail to stand up to legal scrutiny in the next few days, would that be bond positive or bond negative?
That's a hard one. I think it's bond positive because there's less uncertainty. You know what? It's probably bond negative. It probably increases the uncertainty because I don't believe if they're reversed in the next few days, that's going to be the last chapter. So it increases the uncertainty until you get the last chapter on tariffs, whether they stand or not, be it through legislation or legal things. So it increases uncertainty. So bond negative immediately.
I appreciate that you're thinking this through in real time. Thank you, Earl. Thank you very much, sir. Earl Davis there of BMO. Something we've all got to think about maybe over the next 24 hours.
Yeah, this idea that more uncertainty is not a good thing for markets, given the fact that they've looked for certainty. And right now, people debating whether the central bank is becoming more politicized or whether unsustainable policies and governments are going to force central banks' hands. And that's what we've seen increasingly.
It's all very calm, isn't it? Equities going nowhere on the S&P 500, very close to all-time highs. Bond yields actually a little bit lower this morning at the long end of the curve, the 30-year at 490. Coming up next on Bloomberg Surveillance in the second hour, we'll catch up with Stuart Kaiser of Citi, John Lieber of Eurasia Group, the IMF Deputy Managing Director, Gita Gopinath, plus Chris Maher of OceanFirst Financial from New York City. This is Bloomberg TV.
It's a very dynamic economy. Things could be materially different next year.
The labor market is in the process of weakening and will continue to weaken.
Ultimately, the Fed is on an easing trajectory.
If we're just on a path towards more gradual rate cuts, there is effectively been a K-shaped recovery in the economy for a number of years.
As we get a sense of who the new Fed chair will be, we might very well have to build in a more dovish reaction function.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now, and your price action looks like this. Nvidia is only negative by close to 2% in the pre-market, even with an underwhelming forecast. And the broader market, check this out, is doing okay. Equity futures on the S&P 500 basically unchanged. The outperformance coming from the Russell, up by 0.5%. The why is coming from the bond market, reassessing the path forward for the Federal Reserve in the last week or so. A 2-year yield down to 361 88.
And it goes to this conundrum that you talked about earlier. The economic data pointing to some weakening, at least, in consumer confidence and consumer spending power at the same time that people are planning for a revival of said consumer confidence and spending power on the heels of rate cuts, which is reviving the belief in the Russell 2000. It's head spinning at the same time. Rate cuts are making everybody really happy. With the NVIDIA point, though, it is interesting to note people are seeing this more as a China problem than a broader AI issue.
Well, when it comes to China, they're in a very tricky position. One, it's the on and off policy coming from Washington, whether or not they can get these export licenses to sell. They were able to get the export licenses to sell. Now they're saying they potentially will face litigation because the 15% profit the U.S. government wants to sell them. And then at the end of the day, China may not want them. So Jensen Huang has to make another trip to Washington, D.C. to up another ask, the Blackwell, and basically saying that this is sustainable, good AI policy to make sure the U.S. is dominating in the Chinese market. But the market is left with so many questions about what actually they can do in China.
The stock is down by 1.6% in the pre-market. As we've said repeatedly so far this morning, the rest of the market's doing all right. Pretty much unchanged on the S&P 500, all-time highs. Coming up this hour, we'll catch up with Stuart Kaiser of Citi as investors shake off underwhelming NVIDIA results. John Lieber of Eurasia Group on the growing legal fight at the Federal Reserve. And Chris Maher of OceanFirst Financial as bank stocks hit record highs. We begin this hour with stocks shaking off a tepid NVIDIA forecast. Stuart Kaiser, the head of equity trading strategy at Citi, writing the following. NVIDIA's earnings is the largest event for the S&P 500 over the next month. For equity investors, the AI theme and the impact of that on returns is on par with the Fed. Stu joins us now for more. Stu, good morning.
Good morning.
Things are pretty calm, aren't they? What do you make of that?
I think the NVIDIA numbers were just about good enough, effectively, probably right at the low end of where the whisper number was. The China stuff obviously adds a little bit of noise to it, but I mean, margin 70, 73.5% exactly they wanted to be, $54 billion in revenues. I think that the test here was if NVIDIA was really strong, what would it have done to the Russell trade? And I think that's what a lot of people were sort of debating was if we get because Snowflake and MongoDB, both very strong results on the software AI side. If you had gotten that from NVIDIA, would that have made people U-turn out of the Russell and value trade back into growth? It doesn't seem like the numbers were strong enough to do that, but they were strong enough to keep the S&P from selling off.
So a milquetoast NVIDIA report is good for small caps.
At least tactically, as Lisa highlighted with the mix of policy versus data, I think that small cap trade has really poor risk reward as we go into September because it's a careful what you wish for. Good news, bad news type situation.
You love
but
it.
Exactly. But yeah, I think the NVIDIA report kind of like threaded the needle, right? It was strong enough that you didn't get kind of a liquidation in those long positions, but it wasn't so strong that it disrupted the rotation that's been going on for the last couple of weeks.
Is this actually a connected idea that somehow big tech winning is small companies losing? Or is this just simply that markets can only focus on one idea at a time? And if they're not focused on AI, they're focused on the Fed?
Yeah, it's probably a little bit of both. But yeah, I would agree with that. I think there is some view that how do you keep up with the spending that these hyperscalers are doing? Or if you're a smaller company, look, the market right now is to some degree in one big trade, right? And that trade is long growth, long large cap, long the AI thematic, right? And everything else has sort of been ignored to some degree. What we saw in August is people trying to re-engage with those smaller cap, lower quality laggards to some extent. And to your point, I mean, there's a limited amount of money, right? And money's got to be in one place. And right now it's getting kind of rotated a little bit into that value trade.
Is any money coming out of bonds and going into stocks? And this is something that a number of people had been flirting with earlier in the year, the idea that they could get better yield on stocks at a time when inflation was going to be a little bit more elevated than, say, bonds, especially with uncertain policy.
Yeah, it'll be interesting to see if the Fed actually does start cutting and those money market yields actually get down to a level where it's a little bit attractive. If we see a re-engagement, if you look at the balances in retail money market funds, I mean, you're at like $3 trillion. It's a lot of money. Not all of that is coming into stocks, right? I think some of that was basically bank account money that got put into money markets for yield. I don't necessarily know that would go directly into equities, but there's a potential you get a little bit of a tailwind there. The question there, though, is if there is why are they cutting is ultimately what this gets into. If they're cutting because the labor market is falling apart, money is not going to be rushing into equities, and that's going to be net negative for Russell, et cetera. If they're cutting because that sort of base case is in play where they're just gradually going back to neutral and an otherwise solid economy, then, yeah, you might get money out of bonds into equities.
Well, with the event of NVIDIA behind us, what's the market going to be focused on now? Is it squarely on the labor market report ahead of the Fed meeting?
Yeah, I think it's payrolls, and then September 9th, you get the BLS revision to payrolls, which, as you cover Trump, I'm sure that'll be very sort of
Trump
toxic
said
event.
this week in the cabinet meeting that he expects a very strong labor market report.
He might get a decent labor market report, but look, I mean, consensus is sub 100K. Chair Powell last week said break even on jobs right now is 50 to 75K. So look, I mean, a strong report right now would probably be 125. But, our economists think you might get, 400,000, negative revisions from the BLS benchmark. That is not going to go over well politically. And honestly, from a market's perspective, that's a sneaky event on September 9th. How many jobs get kind of revised out of the BLS?
It's a really odd setup, isn't it? This market's pricing in a cyclical upturn. Federal Reserve's really concerned, increasingly concerned about a cyclical downturn. What gives? I agree with you 100%. I actually thought the response to the Fed was much more positive than I would have guessed. I think what happened was the initial headline was, about they're getting ready to cut. But if you read his speech, it was because they are seeing some, weakness in the labor market. Not only are they saying weakness, they think the risk reward is really poor. And then a lot of folks, I think, believe that they're prioritizing growth. But he also specifically said we're not going to allow tariff-driven inflation to become a bigger problem. So I was surprised, honestly, at how positively the market reacted to the Fed. But yeah, I'm with you. I think you have a little bit of, I don't want to say disagreement, but you have a situation where the Fed is clearly worried about the growth side of their mandate. The market has been willing to ignore that to some degree. And as I said, I think that gives you really poor risk reward in some of these smaller cap trades. There's a phrase I really don't like, but I'm going to use it, hawkish cut. Is that kind of what you're thinking about going into September 17th? Of course, all relative to what's expected at the time and what comes in on the data front over the next few weeks. But is that where you're at now? I guess, in the sense that, yeah, they are probably going to cut. And yes, I think they're going to be very cautious in how they message that, in the sense that this is not, an aggressive kind of cutting regime. Now, look, if you get a very weak labor market report, that cut may not come across as hawkish. So, they are very, very data dependent. But all else equal, let's say we print a consensus job number of, call it 75K, and you get an okay inflation print, then yes, they'll cut. But to your point, they're not going to message this as an aggressive cutting cycle. They're probably going to message this as a meeting by meeting process that is data dependent.
So if you just turn this on its head and take it a step further, is this essentially a market that's hoping this is a politicized rate cut and that it's going to be a politicized rate cutting cycle that doesn't necessarily warrant it based on where the economy is, which will give fuel to equities, but won't actually be as a result of economic weakness? Well,
to keep myself out of trouble, I'm going to call those insurance cuts. Yes, and I think the market would probably, enjoy some insurance cuts. Look, there is a sneaky Uber bull case out there lurking, right, which is that for 3 months, corporate America sat on their hands, did less hiring, did less capital investment because of the uncertainty around tariffs and taxes and immigration. And we get into September, things have calmed down, and you have budgets that need to be spent into year end, and you get some hiring. That is a low probability, but very kind of, bullish outcome.
You say that it's low probability, but I was looking at your very own economic surprise index, and it actually is at the highest, the most positive going back to the end of last year. So if you see, yes, the economic data hasn't been great, but it's been trending in the right direction. It's actually going the opposite direction of some sort of doom and gloom in the economy. So how do you square that with the idea that there really is weakness under the hood that the Fed is responding to?
Well, what's interesting about that, too, is a lot of it's coming from the soft data, which is survey data. UMich was actually quite weak. So it's the survey data that's improved.
You're triggering.
No, but the survey data that's improved has been corporate survey data. It's been the PMIs. So in the sense, if you believe that corporates are going to re-engage, that's very positive news. If you're worried about the labor market, you're kind of a little more circumspect about it. So agree that the data looks pretty good. Look, economic surprise can be positive for two reasons. It can be really strong data or really low expectations. In this case, it might be that the expectations were kind of low and we're clearing a relatively low bar.
That kind of setup with corporate America having the one big beautiful bill, deregulation, and some clarity on tariffs. What does that mean for the Fed in 2026?
I mean, it probably means the Fed will be really, if they're in a cutting cycle, doing it very, very methodically and maybe like a quarter-to-quarter basis instead of a meeting-to-meeting basis. Look, if you were to have all of that stuff kind of coalesce into a little bit of an upturn in the U.S. economic data, then, the Fed is going to be much more focused on ensuring that the inflation risk is out of there. I mean, you have a Fed chair who was there during an inflation surge, is getting ready to leave that seat. I can't imagine he wants to leave that seat with inflation pressure again kind of being an issue. So it would actually be a blessing for the Fed, I think, if you got an upturn in corporate economic activity that allowed the Fed then to kind of take their time.
I didn't take you as a you-Mitch kind of guy. I used to be a you-Mitch kind of guy, and then I realised the respondent rate. The response rate is just ridiculous.
Yeah, you need to defend yourself here because, you-Mish kind of guy evidently is
sort
of your new kind of...
it's like conspiracy theorist, you-Mitch kind of guy.
This is what happens when the British come. They don't like the Dow. They don't like
I don't think Governor Waller likes the you-Mish.
They're anti-America.
Oh, well, please.
Oh, please.
Oh, is you-Mish
brutal.
anti-American? Oh, boy.
I'm more pro-American than half this country right now, Stu.
Fair enough. I'll give you that. I'll grant you that.
Stuart, Kaiser of Citi. Go away. Let's get you an update on stories worldwide. That's true. Let's get you a Bloomberg brief with Yahira. Hey, Yahira.
Hi, John. We start with our top story. NVIDIA trading lower 1.8% in the pre-market. The chip maker gave a tepid revenue forecast for the current period, signaling that growth is decelerating after a staggering 2-year boom in AI spending. NVIDIA says it expects sales to be roughly $54 billion in the third quarter, in line with the average analyst estimate on Wall Street. And on the flip side, we are seeing TD Bank shares rising 3.75% in the pre-market. The bank reported third quarter earnings that beat Wall Street estimates. TD saw record revenue in its Canadian business, which was a key point of focus for growth in the wake of its U.S. anti-money laundering issues. And a correction on an early reporting about the incident at the U.S. Open. Taylor Townsend was the tennis player who claimed her opponent, Jelena Ostapenko, told her that she has no class. The tense moment came after Townsend won their second round match. Ostapenko says Townsend disrespected her when she didn't apologize about breaking an unwritten rule over a netball. That's your Bloomberg Brief. John?
Yahira, thank you. Thanks for the update. Up next on the programme, asserting control at the Fed.
I think these are bogus charges. This is more about his effort to exert control over the Fed because I think they're concerned that their trade agenda is causing great weakness in the labor market, and they want rates lower.
Up next, John Lieber of Eurasia Group from New York City this morning. Good morning. Live from New York City, welcome to the programme. Equities doing okay, no real drama whatsoever so far this morning. Futures negative by not even 1/10%. A touch of underperformance on the Nasdaq 100 and a little bit of outperformance on the Russell. Small caps making a comeback, winning again this morning by 0.45%. Under surveillance this morning, asserting control at the Federal Reserve.
I think these are bogus charges. I believe there's probably plenty of people in the administration who have done the same. This is more about his effort to exert control over the Fed because I think they're concerned that their trade agenda is causing great weakness in the labor market, and they want rates lower. And to be fair, this is what the president has always wanted, is lower rates.
Here's the latest this morning. A lawsuit from Fed Governor Lisa Cook looming as President Trump attempts to fire her over allegations of mortgage fraud. With the latest, here's Bloomberg's Tyler Kendall. Hey, Tyler.
Yeah, hey, John. Well, Fed Governor Lisa Cook could file her lawsuit as soon as today, challenging President Trump's efforts to oust her. Our eyes are glued on the dockets to see when this lands, because it is widely expected that Cook is going to seek something known as a preliminary injunction, which would decide whether or not she's able to keep her seat, not to mention vote in the September meeting, while the broader issue of her firing plays out in the courts. And I spoke with one legal expert who said it is really this decision on the injunction to pay close attention to here, because that is going to set the tone for at least the next few months as this really does play out in the legal system. And as you well know, President Trump says that he has sufficient cause to fire Cook over allegations of mortgage fraud, but we should say no formal charges have been brought against her. Though we did get some new insight yesterday into how the White House is thinking about this idea of cause. I think it's worth mentioning again that we had the White House senior trade advisor Peter Navarro on Bloomberg Bloomberg Television, who said that the White House is prepared to argue that it does not matter when these allegations took place or that they have to do with private conduct instead of her work as a Federal Reserve governor. That is going to be one of the top questions that the courts have to decide because, of course, the stakes are very high here, but perhaps there is even heightened pressure by the fact that Cook's term is not expected to end until 2038. And John, we did get a statement from the Federal Reserve earlier this week outlining that one of the reasons why Fed governors have such lengthy tenures is to basically insulate them from political pressures. The Fed also said that it will abide by any legal court decision. It's a sentiment that was echoed by President Trump as well when Annmarie pressed him on it during a cabinet meeting earlier this week.
Tyler Kendall with the latest. Tyler, thank you. To extend the conversation, joining us now, John Lieber, Managing Director at the Eurasia Group. John, welcome to the programme. What are you telling clients about how you think this ends down in Washington? What's the end of this look like?
I mean, like we just heard, the end of this comes with the Supreme Court case. And the Supreme Court has been fairly deferential to the president in his exercise of executive authority, at least so far this year. And I don't really think this issue is going to be that different. So I expect Cook will be removed by the courts. I mean, I'm not a legal expert, so you should probably talk to folks who are. But I think she will be removed by the court. Trump will be able to put his people on the board. And what that means is that by the middle of next year, you'll have a majority of Trump appointees who are going to be much more susceptible to listening to what the president wants, which is lower interest rates, no matter what the facts say. So I think that's where this is headed. This is about control of the Fed, and that's Trump's goal. And it looks like he has the tools in order to get there.
Tobin Marcus had the same view when it comes to Supreme Court in the last hour. I just push back on this idea. The Supreme Court signaled that they think that the Fed should be a shield, should not have this political pressure, saying it's quasi-private entity. Why is that not going to be the take from the Supreme Court this time around?
Right. So the Fed said that in the context of Trump's ability to just kind of randomly fire people at the heads of agencies because he doesn't like them. But what's unique about this situation is that the statute, the Federal Reserve statute, the one that created the banks and created the board positions, says that the president has the ability to remove people from the board for cause. And that's why the pretext of Cook's mortgage allegations is important here, because it's giving Trump cause to follow the statute and then remove her and then presumably other members of the board as he wants if he finds cause. I think that's going to be one of the important parts of the court's litigation here, of the litigation in the courts here, is whether or not he has sufficient cause to remove her. And like I said, they've been so deferential to the president. Why wouldn't they say that he's the one who gets to determine what cause is?
This is going to be the final straw when it comes to this legal process. In just the next few weeks, do you think she's going to be able to stay at the Fed? Will she be at the September meeting when they decide on the next interest rate to cut?
Yeah, that's a lot harder to say. I don't know. I mean, this question of the injunction is important. And, the Fed said they're going to follow whatever the courts say. So if the courts give an injunction and tell that president that he can't remove her, then I think that she'll probably stay in her seat. The Fed will let her in. That could cause some controversy. But, the White House has been deferential to the legal process as they've done these expansions of executive authority. So it's just a question of whether or not the courts grant this injunction. If they do, she's on the board. If they don't, I imagine the Fed escorts her out of the building and tells her, you've got to fight this out in the courts, and we'll see you once you get a decision.
John, are you surprised that there hasn't been more of a discussion around why there is not an investigation that has been revealed about exactly what the allegations are? I mean, it feels a little bit frustrating to be speculating on something that seems to lack a lot of details.
Well, I actually think that's one of the wilder parts of this story is that the whole allegation came out of the FHFA, which has no business randomly looking into the mortgages of high-ranking federal officials. And it looks like that's what they're doing. So I actually think that's probably an underrated piece of this is the weaponization of these federal agencies against people that the Trump administration doesn't like. I would have kind of thought this would come out of the IRS before it came out of the FHFA, but it came out of the FHFA. And what's another interesting data point here is that she hasn't directly denied the allegations against her. Maybe she doesn't remember and has to look up the paperwork like she says, or maybe she did it and it's actually a fairly common practice. I don't know, but I think that's a interesting thread to pull on here.
And as the story does progress, and if there is going to be some sort of replacement on the Fed, we know there's going to be a new Fed chair. There's a question of what the role of Congress is going to be in terms of confirmation and how high the bar is for them, for someone who is an independent thinker versus someone who wants to lower interest rates regardless of the economic backdrop. How much of a check do you think there'll be on that?
Right now, I don't think there'll be a check at all. I mean, I think that they've basically rolled over for everything Trump wants so far this year. They're appointing people to the judiciary, to law enforcement positions who are pretty unqualified. And I think that right now they're in a mood to give Trump what he wants. Now, the Fed is a unique institution. And one of the reasons it's unique is because it affects a lot of people that fund campaigns. And so there's going to be a lot of political donors that are in the ears of members of Congress over the next few months about the quality of Trump's replacements on the board. But I think that could have some influence, but I'd be very surprised to see them stand up at this point and deny the president the ability to appoint the people that he wants.
John, this morning, who is running the CDC, given what took place overnight?
Yeah, I have no idea. I mean, you look at these other removals that are happening at the CDC, at the BLS. You look at what's happening at the Defense Intelligence Agency, and it's clear that they are going to put Trump's people in place. And if you aren't on board with the Trump administration's agenda, you're going to be out. So I don't know what's happening at the CDC. I think that'll be an important storyline to watch over the next few months.
But this person was a Trump pick, no? So what happens now? Is this going to be another legal battle that we're seeing take place as well, similar to Governor Cook?
Well, what I saw last night from the press releases was that she hadn't been officially informed that she'd been removed from her job. I imagine the president has the ability to remove her if he wants, or the secretary. That could just be a process thing, and she just has to get the letter in the mail that says she's gone. She doesn't have the same protections, as far as I know, that the Federal Reserve does. I imagine if they want her gone, she's out.
Hey, John, appreciate your take. As always, sir, thank you. John Lieber there of Eurasia Group on the current situation down in Washington. As if the job of the Federal Reserve wasn't hard enough right now, they've got to confront some really conflicting data. This morning, Dick's raising its outlook. Another retailer in America saying that things might get better going into year end. I think Victoria's Secret doing the same thing too.
We've seen that across the board. We saw TJ Maxx come out beating expectations. This is the reason why some people, including what our conversation to start off the show is all about, how earnings expectations have actually gone up for the Russell 2000. So it's not just rate cuts. It's actually that things are getting better, which speaks to the big bull case that Stuart Kaiser was laying out, that maybe there is sort of a soft patch, rate cuts, and then better data that already is in the pipeline with companies ready to spend.
It's this really odd tension right now. Market pricing a cyclical upturn, Fed worried about a cyclical downturn. Christian Mamani was in that chair yesterday. Christian making the point that he thinks the real risk here is reacceleration, just as the Federal Reserve is cutting interest rates.
Yeah, and how much does this really feed into inflation? And I think that that's really the question. Is it re-acceleration in an increase in productivity and hiring that all comes with this disinflationary tilt? Or do we see inflation pick up in a way that a lot of people were expecting on the heels of tariffs and some of the sort of disaggregation of traditional supply chains?
It's an interesting moment. Q3 into Q4 into year-end 2025 and then 26 for the Federal Reserve once we get to May. Sort of in no man's land. Who knows what happens in 2026? Futures on the S&P 500 just a little negative this morning, down by close to 0.1%. Coming up on the programme, we'll catch up with Gita Gopinath in her final interview as the IMF Deputy Managing Director. Plus, we'll catch up with Danny with your morning movers. I mentioned Dick's Sporting Goods. We'll also talk about Victoria's Secret boosting its full-year outlook. That stock up in the pre-market by 8% from New York City. This is Bloomberg. Some pretty decent reports from retailers so far this morning. We'll get to that in just a moment. Here's a snapshot of the price action. Equity futures on the S&P just a touch negative, down by not even 0.1% on the S&P 500. Outperformance again on the Russell. Small caps up by 0.4. Let's get you those movers, those single names, your morning movers with Danny Berger. Hey, Danny.
Hey, John. Yeah, for the most part, they were positive. Let's start with maybe the uncertainty around Best Buy. When it first reported earnings, shares were down nearly 2%. Now it moves to unchanged. The nervousness is around what happens with the holiday period. They've raised prices, so this current quarter was pretty good. They beat on all the metrics, but they did not change their outlook. So do consumers finally start pushing back against higher prices? Again, this market trying to decide what to make of it, and then the shares go positive. Now, the blatantly positive story, starting with Victoria's Secret, shares up 7.33%. They raised their outlook for the full year, and not just that. the CEO in the earnings release talking about how their margins have really started to strengthen, that it's not just sales growth, that they've been able to pull different levers to make sure that they're not impacted by higher prices. Then there's Dick's Sporting Goods as well, really clear demand for the products that they're selling. Even so, this one flipping too. Dick's initially raising their outlook for the entirety of the year. Initially, shares rallied to a healthy amount, those starting to come back too. Again, it's this question, do things remain sunny during the holiday period? They also have to incorporate Foot Locker. It doesn't seem like there's quite yet a clear plan for what they're going to do with that when the acquisition is complete. So those shares now starting to slump, John, giving up earlier gains.
Danny, thank you. Appreciate the update. More from Danny in the next hour. On our radar this morning, stocks shaking off an underwhelming forecast from Nvidia, with the chip maker missing lofty expectations. Now, the CEO, Jensen Huang, saying it's a real possibility the company brings its advanced Blackwell chip to China. Elsewhere, the Mexican government planning to increase tariffs on China following pressure from President Donald Trump. The levies likely impacting cars, textiles and plastics. Specific tariff rates are not yet clear and the plan could change. And finally, the European Union considering secondary sanctions to stop other countries from helping Russia circumvent the bloc's existing sanctions. The EU foreign ministers are also weighing measures to target Moscow's oil, gas and financial sectors.
Remember when the Treasury Secretary told us that when they were talking about secondary sanctions or tariffs, he was sitting down with European leaders and it got really quiet. Everyone at that moment, to his words, started looking at what kind of shoes they were wearing. Well, the Europeans are actually finally considering this. This potentially is what the United States is doing when it comes to basically India. We are going to put a penalty on you if you keep buying Russian oil and gas. The issue, and you keep making the same point, Europe is still importing Russian energy at this moment.
Some good developments, though, for the White House, those two stories. One, to get Mexico on side. Mexico was heading in that direction anyway, I think. So, point one. Point two, just the idea that also the secondary sanctions story goes along with the Mexicans doing that. I think those two things add up quite nicely. Get the Europeans on side, Mexico on side. That's what the White House wants to see.
The White House is forcing trading partners to choose between it and China, it and Russia. And that is the reason why maybe, and it relates to the idea of India trying to get closer to China, because there has been the us or them mentality, and you're seeing that in some of the sanctions plans elsewhere.
Let's stay on the global economy. Gita Gopinath has been Deputy Managing Director of the International Monetary Fund during one of the most transformative economic periods in modern history, including the pandemic, inflation shock and the push to deglobalize. After 7 years at the IMF, she's stepping down tomorrow and joins us now for a final conversation. Gita, welcome back to Bloomberg Surveillance, and thank you for sharing your time with us this morning. Let's start there. Let's look at your time at the International Monetary Fund. Just how much has changed over almost a decade?
Hi, and a pleasure to join you. Pretty much, I think everything has changed. I started at the IMF in 2019, and that feels like that was the calm before the storm. And you had the pandemic, you had war in Ukraine, and now geoeconomic fragmentation. I think the global economic order is transforming in ways we haven't seen in decades, and it's still highly unclear where the global economy will settle. I think a second big difference between 2019 and now is on the fiscal front. Debt levels are incredibly high. They are ever increasing. And while in the past you might have said, so what, markets will take it, that's not the case anymore. Even in advanced economies, you see that in France, the UK, and also in terms of long yields in the US. And I say the third big change is on technology. AI over the last few years has certainly caught the imagination of everybody, huge promise, but also huge risks.
How has the IMF's role changed during this period, given that it was set up under a very different infrastructure at a time when a lot of people are saying we're now in the post-Bretton Woods era?
The IMF has great experience dealing with turbulence. You know, there was a period when you had the end of Bretton Woods going off the fixed exchange rate to the dollar and the dollar to gold. That change happened and the IMF adapted. And we are obviously now in a world with big shifts in terms of how countries work with each other. The IMF has always functioned as trying to do the art of the possible, which is do the best you can given the constraints, and done it very successfully. So if ever there was a time for this institution, it's super important now. It has the ability to bring different countries together around the table, good discussions to happen in the economy, on the outlook. Again, a very vital institution for the world.
Do you see a risk that it doesn't survive, though, at a time when funding is really in question with a lot of major economies? We've seen China go it alone. There have been questions about the United States.
Firstly, the IMF's funding structure doesn't rely on any budgetary support from any country. So it's in a very strong place because of that. And everything we've seen so far points to all the members wanting the IMF to continue functioning as it has. We work very closely with the U.S. administration. That engagement is going extremely well, but also the other 190 member countries that we have. So as of now, lots of support. Of course, the environment has changed, and the IMF is going to adapt to it in this new geopolitical environment that we have. But it has a lot of experience dealing with these kinds of events.
One thing that you've done during your tenure at the IMF is really study the change in the geopolitical relationship. You've talked a lot about that, including the reliance on the dollar, and that's been a point of big speculation of late in markets as well. How much are you actually seeing worldwide nations try to shift to alternatives from the greenback, this idea of insulating themselves from some of the policy uncertainty that have made a lot of headlines this year?
So we do see small shifts on the margin, right? We are seeing countries diversifying out of the U.S., but again, on the margin, because they were so exposed to the U.S., several of them are hedging against dollar risk. We're seeing some of that too. But I think the narrative that somehow something has dramatically changed about the behavior of the dollar, it's really too early. People point to the correlation between what's happening with long-term bond yields and the strength of the dollar and saying, well, that's changed, and therefore something has changed dramatically. That's not the case. If you take a long enough period, the relationship between the dollar and the borrowing costs is, it can move in different ways. So there's nothing unprecedented. But of course, these are still early days. We shall see where all of the shifts in the global economic order are headed, and I think that's the source of tremendous uncertainty that's still weighing on the world economy.
How much has any perceived loss of Fed independence changed that? And we've been talking about how there's this dissonance between the commentary by a lot of analysts and economists about the fear of some sort of loss of independence and then a lack of market reaction that you would kind of expect on the other side. Are you seeing any shifts that maybe are less visible?
I think everybody agrees, and this would be markets and economic professionals, policymakers, everybody agrees that central bank independence is critical, monetary policy independence is critical. So if we are not seeing much market reaction, it must be that people think that, well, that independence is still intact. That independence has been critical to bring down inflation from the high levels we saw post-pandemic. Inflation expectations were anchored. Because of that, inflation came down. So I don't think there's any ifs and buts about that. It must be that everybody still believes that independence, especially operational independence in terms of setting monetary policy rates, will be maintained.
So you reject the idea that the market's just somehow ignoring a reality or something like that. You think the market's speaking and that we should listen to the market?
No, I just think that everybody at this point is functioning under the fog of uncertainty. I mean, there's really a lot of information thrown out there. Separating the wheat from the chaff, it's not that easy. And so I think everybody is on wait and see mode. And right now, at least, of course, I think that the markets are putting very, very low probability on any big negative event. That may be excessive. I think there is more to worry about than what the markets are showing right now. But again, we should have to wait and see.
Gita, let's put some of these things together. If you look at developments in the UK, in France, the inability to address fiscal concerns and find that additional fiscal space, the latest developments here in America as well. Are you witnessing, do you think we're witnessing a convergence between the kind of dynamics we typically see in EM with DM? And do you think those terms are useful anymore in quite the same way?
I think we have certainly moved away from the case of advanced economies, rich economies can keep increasing their debt, which is what's projected to happen, and there's not much to worry about. I think we're certainly past that. Major economies are beginning to worry about what's happening to their yields. You're seeing that. It's a major concern in France right now as we speak. But even in the US, long-term yields are basically back to pre-GFC level. We are away from that world of big global savings glut, away from that world of central banks buying large amounts of government assets. So I think it would be really complacent for any government, rich or poor, to say that, well, no, our debt will always be bought. And I think one point I want to make is that we talk about resilience for the global economy, and which has been really the positive of these last many years, despite all these shocks. But we should recognize that the reason we've seen resilience is because we haven't had a financial crisis, despite the pandemic, despite wars, despite geoeconomic fragmentation, despite Fed rates going up very sharply. We've not had a financial crisis. That doesn't mean that that will never happen. We have very high levels of debt around the world. I think bond markets are in a fragile place. You have valuations in equity markets that are sky high. So I would say tread carefully, because if you do have a financial crisis, we know the scarring that comes from that is long lasting.
And when you talk about a financial crisis, some people were wondering what could potentially trigger it. Are you saying that the sovereign debt market of developed markets is of the greatest concern at this point?
I mean, usually when you get a financial crisis, it's a combination of events that can trigger it, right? And so if you have multiple markets that seem to be in a vulnerable position, you could end up with a negative event, right? And so the bond markets, what you're seeing with very high levels of debt, fragility associated with that, equity valuations that are very high. Yes, there's a promise that maybe AI will truly transform the world, but as we know from the dot-com bust, even a technology like the internet that did transform the world went through a boom-bust cycle. So that combination, non-bank financial institutions, we've never had a crisis. Well, they've been as large as they are right now. The amount of corporate borrowing that's happening with NBFIs, much higher than pre-2019. So there's a lot that looks stretched at this moment. And at the same time, I think the world economy is gambling with all kinds of new policies. So I would say tread carefully, make sure that financial supervision and regulation is continued, see what needs to be done with NBFIs, what's the appropriate level of supervision and regulation that's required over there. All of that is going to be very important.
So you're leaving the IMF and you're going back to Harvard, a university that you've known very well. What are you going to be doing there, and how important is it for you to really get this sense back in the economics profession of pure research and true rigor versus some of the politicization that we've seen recently?
So I think the reason that the economics profession has been able to contribute so well over these last few years is because in the face of unprecedented shocks, you really need to go back to some of your training to figure out how you're going to respond to a pandemic that you haven't seen in 100 years or war in Europe, right? So having that base of knowledge is very important. But at the same time, I think the economics profession has to recognize that there is something of a trust deficit, especially with mainstream economists, and how do we get over that? There's broad consensus in the economics profession that open trade, central bank independence, super important. Those are the crown jewels for good economic policy. And yet the policy direction is away from that. So I think there is absolutely some bit of soul searching, some bit of stepping back and asking yourself, how do you solve this trust deficit? How do you make sure in this new world of communication that the good ideas still come through?
Gita, you've always been generous with your time. We appreciate it, and we wish you the best of luck. Thanks for sharing your time with us this morning. Thank you. Gita Gopinath there at the IMF. Your final point is so important. How do we divorce partisan politics from policy making? And the answer, of course, is with great difficulty.
Well, and this is something that's been a perennial issue, but it's even more so at a time of increasing polarization, because ultimately, can't you say that your vision for the economy is intimately tied to your vision for some sort of political system? I will just say that second-guessing oneself and sort of a rigorous debate is appropriate, and I think that the question is, how do you get to that at a point when a lot of people don't seem to want that?
If you are just tuning in, welcome to the programme. Equities at all-time highs at a close yesterday. Futures just a little bit softer, with an update on news worldwide with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. North Korean leader Kim Jong-un is visiting China for its military parade next Wednesday. Other world leaders, including Russian President Vladimir Putin, will also be in attendance. Kim's appearance will be his first overseas trip since his 2023 talks with Putin, and is set to underscore the three leaders' growing relationships. Meanwhile, shares of Dollar General are rising 6.5% in the pre-market after the discount retailer posted stronger than expected sales and raised its forecast. An increase in higher income shoppers looking for deals has helped Dollar General bring more traffic to its stores, even as its core customer base feels the squeeze. And there's been another major shakeup within the Trump administration. CDC Director Susan Menarez was fired just weeks into her tenure. Her attorneys say Health Secretary Robert F. Kennedy Jr. targeted her because she refused to, quote, rubber stamp unscientific, reckless directives. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. Up next on the program, bank stocks at all-time highs.
We continue to like financials. You're going to continue to see at these levels of market excitement and sentiment, capital markets recovery.
In just a moment, we'll catch up with Chris Maher of OceanFirst Financial. That conversation up next. Equities on the S&P 500 a little bit snoozy, unchanged on the S&P 500 this morning. On the Nasdaq, down about 0.1%. Elsewhere on the Russell, up 0.4%. But check this out. Remember what we said about Walmart? Good news at Walmart, probably not good news for the broader economy. Some debate about that, but good news at Dollar General. That stock is up by 6.4% in the pre-market. What does that tell you about the broader economy?
Yeah, alarms going off. Oh no, Dollar General, people are looking for discounts and trading to lower cost places. You're seeing this also from TJX and Ross stores and all these discount stores, but maybe we're seeing it elsewhere too.
So maybe much conflicting information, isn't there, Bramo? It's so confusing.
I mean, right now, I can't tell you I've got answers, which is the reason why I'm going to take tomorrow off.
Likewise, long weekend. Spend money.
Exactly.
Help the economy, Bramo.
This is just the American way.
Right there with you. Spend, spend, spend. Equity futures close to all-time highs. Under surveillance this morning, bank stocks at record highs.
We continue to like financials. People have actually been better sellers of banks. So I would say positioning today is not really that full on the institutional front. You're going to continue to see at these levels of market excitement and sentiment, capital markets recovery. And lastly, deregulation, right? This is an area of the market that should benefit really well from deregulation tailwinds.
So here's the latest this morning. The KBW Bank Index hitting fresh record highs. Chris Maher, the chairman and CEO of OceanFirst Financial, writing a rate reduction in September may result in a slightly steeper yield curve, which will provide for margin expansion at most banks over time. Chris joins us now for more. Chris, good morning.
Great to be with you.
Let's talk about your business, and it's good to see you, sir. Mainly focused on the Northeast still, right?
That's right.
How are corporate clients approaching this moment?
It's really interesting, John. Earlier in the year, we had that trepidation over what's happening with tariffs and people uncertainty about tariffs and rates and even the big, beautiful bill, which resolved some tax issues. Taxes were another big thing. That's all kind of fading. We have record pipelines. Customers are making investments. They're making commitments. We're seeing a lot higher rate of velocity than we did earlier in the year, which is nice to see.
Can you describe the kind of industries, the kind of businesses that you're talking to right now?
Sure.
And in what ways they are re-engaging with the economy?
Yeah, so we cover a very wide swath. So it's everything from shipping, for example. We have a great shortage of ships in the U.S., especially Jones Act ships. It is everything around data centers, which are not just chips, right? It's the data center, it's concrete, it's power generation, it's all that. Housing is another big one. And then there's logistics around warehousing and manufacturing. So people are adjusting to the new kind of tariff regime and making investment decisions now that are long-term in nature.
How much of it is dependent on the idea of lower rates going forward?
You know, some of it is, Lisa, but not as much as you'd think. Most commercial borrowing happens at the short end of the curve, and whether it's a quarter point or a half a point off of that really wouldn't make a big difference in your investment decision. I think the bigger issues were tax policy, tariff policy, the kind of long-term things that will impact stuff.
A lot of what you mentioned were industrial companies looking for industrial projects. I just wonder, what about the consumer-facing companies, especially as we see low-cost retailers do better, and some questions around some of the other retailers? Is there sort of a bifurcation between the consumer-facing and the industrial?
That's right. And Lisa, as you point out, it's the low end in the consumer is a little bit more stressed than the high end. And we've seen over the last 5 years has been an interesting trend. More and more of U.S. spending is in higher income spenders. So although there is weakness on the low end, that's a smaller dollar fraction than it's historically been. So We really need to watch the high end, and if those numbers start to pull back, you could see real weakness in the economy.
Are commercial clients out and hiring again, though?
Well, Annmarie, they're not hiring as much as you might like to see them hire. So we're seeing hiring very slow. We're not seeing layoffs. We're not seeing retrenchment. We are starting to see some of that AI impact where people are saying, I may not need to hire that incremental person. Let me just see if I can make it out. There's certain segments like call center that there's just a runoff, and the AI's got so good today that call centers are losing staff at a pretty astounding rate.
And this is the crazy thing, and just to jump in, forgive me, the crazy thing that I see at the moment developing in this economy, that we could see all this investment that's good for the GDP numbers, but then bad for the labour market, and this tension begin to build between what we traditionally would say is good growth, GDP's up, and a labour market that's just not hiring in the same way. How is the C-suite going to navigate that moment? Because at some point they have to sit there and think, well, someone's got to buy the product, and if they don't have a job, what are they going to do?
That's right. You have to be watching the data very closely. The recent weakening in employment data is concerning. We're not seeing any of that in spending patterns. We're not seeing it in overdrafts. We're not seeing it in kind of a FICO drift or late payments or anything like that. But that could turn very quickly. And some of this data has the ability to be very volatile. So if it turns quickly, you don't have a lot of time to react to that.
I get a sense from you the hiring freeze or the slowing to really go out into the market and hire is because of AI, not because of the uncertainty of what the policy was going to be from Washington, especially when it comes to tariff rates.
Yeah, that's what we're seeing now. So earlier in the year, Annmarie, we saw that people were a little bit concerned about what might be coming out in terms of policy. That's kind of set aside now. Now it's really just a question about, do you believe you're going to need these people long term? Because hires are a long-term contract, right? It doesn't matter. It's hard to unwind them and to get out.
Chris, it's good to see you.
Right,
it
John,
always
great
is.
to see you.
Do you want to find a word on the Fed? You feeling good about things, how things are developing down there?
Well, you know what? I'm looking towards September. I think it's time for a rate cut, and let's see how that all works out.
You thinking about 26? What does 26 look like? New Fed chair, chosen by the president, confirmed by the Senate?
One of the things I love about the Fed is that it is the only decentralized central bank in the world. And, we got 12 people on the FOMC. We got all these reserve banks. It is a big institution, and I think it'll weather this.
Chris, it's good to see you.
Thanks, John.
Thanks for catching up with us. Chris Maher of OceanFirst Financial, diplomatic about the future of central bank independence down in Washington, D.C.
You said, how does 2026 look? And my mind just went wild. I mean, I'm thinking of all the potential possibilities, and I think, that's why people aren't really going there.
I can't even get to 2026 still. I know the market is thinking about that re-acceleration in growth and all those rate cuts, but
I can't get to October. I mean, let's get through some of the next
I don't know what's happened
weeks.
since April. Where did that time go?
So listen to us.
It's like September next week. My goodness. Up next, Matt Stucky of Northwestern Mutual, John Vinh of Keybanc, Nela Richardson of ADP, Jim Tierney of AllianceBernstein. The third hour of Bloomberg Surveillance, just around the corner.
If I had to buy something, I would rather buy stocks rather than buy bonds.
I think the investment for AI has to take place now.
AI models are so powerful, driving so much demand that we do expect them to grow into next year.
What you see going forward, though, from the four hyperscalers is clearly more spending.
The AI race continues.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. The third hour of Bloomberg Surveillance starts right now, and your scores look like this. Starting with this name in the pre-market, Nvidia, with an underwhelming forecast. That stock is down by just 1.2%, and the broader market is still positive on the S&P 500, even if it's a bit softer on the Nasdaq. The Nasdaq 100 down by not even 0.1%. The outperformance is on the Russell, up by 0.5, as this market looks for rate cuts. Looking for rate cuts, look for the data. 29 minutes away, jobless claims at 8:30 Eastern Time. Then later, the chairman of the Federal Reserve. I'm joking. He might be. Governor Waller speaks at 6 p.m. Eastern Time.
Yeah, you put those two ideas together. really jobless claims are going to have new import as the Federal Reserve has talked about a softening in the labor market that has been actually more marked recently that they're trying to address with rate cuts. Yes, Chris Waller has already been on the tape saying he wants a rate cut. He wanted one, actually, at the most recent Fed meeting. He will be cutting, or he'll be voting to cut, I'm sure, in September. But what he says and how he messages his caution going forward about some sort of rate cutting path will actually be market moving because of what you just said, because of the expectation that his voice carries a bit more clout.
He's setting the tone for this committee right now. He's setting the tone for the chairman of the Federal Reserve. You said it, Monday, straight out of the gate. That speech on Friday from Chairman Powell in Jackson Hole, Wyoming, sounded like a speech written by Governor Waller.
It was like Governor Waller wrote the speech for Jay Powell and said, this is what you need to read in Jackson Hole, because Jay Powell 4 weeks prior wasn't that worried about the labor market. He wasn't that concerned. He was still really concerned about potentially the tariff impact. Not only did we learn that he has this bias at this moment with this concern in the labor market, but also when it comes to tariffs, it's going to be staggered in terms of when the impact might hit. So basically, giving the market, investors, a chance to just ignore it. That CPI prints we might get, hot, not hot, look through them.
Everyone on that committee right now believes that we are restrictive. So this move in September in many ways is actually quite easy. Drop 25 basis points. It gets harder and harder over time because other people will start to say, actually, I don't think we are sufficiently restrictive anymore. That's when the pushback begins. So it's September, easy. From there, it gets harder into 26. And then you've got the change in May. So there's like 3 different periods here. You've got the September decision, you've got the call between September and May, and then you've got life after Chairman Powell. Life after Chairman Powell could look very different.
Yeah, big question mark, I think, for a lot of people, especially because we don't know who is going to put in his stead. You talk about a phrase that you hate, so I'm going to repeat it ad nauseum, hawkish cut. And are we going to see some sort of signaling going forward that this is going to be not necessarily one and done, but one and then just another one and then just sort of wait and see? That's the key question for anyone who replaces Fed Chair Jay Powell. What is the reaction function if the inflation data comes in hotter? Do they stop cutting? Are they prepared to hike rates? Or are they prepared to look through that and maybe look to yield curve control or beyond? That's when the market might start to wake up.
And this is the changes potentially we can expect with monetary policy. We don't even know if Chair Powell, though, will stick around and basically hover around the Fed and keep his seat as a governor. All of this is also taking place while the president is ousting a governor that as soon as today we can get this injunction. We don't even know if she's going to be there in September to vote. So even though we're talking about changes in monetary policy, tremendous amount of changes when it comes to personnel.
If you are just joining us, welcome to the program. Coming into Thursday, record highs on the S&P 500. Futures this morning, almost totally unchanged. Coming up this hour, we'll catch up with Matt Stucky of Northwestern Mutual as markets try to shake off Nvidia earnings. Vinh of Keybanc Capital Markets after raising his outlook on the tech giant. And Nela Richardson of ADP as we break down the latest jobs data at 8:30 Eastern Time. We begin this hour with stock steady despite Nvidia shares slipping post-earnings. Matt Stucky, the chief portfolio manager at Northwestern Mutual, writes the following. Weakness in the near-term reaction is likely to be short-lived, or short-lived, as they might say, over at the Federal Reserve. We cleared that up yet?
Well, look.
It's short-lived.
Short-lived, short-lived.
We say short-lived. I think that the correct academic interpretation is short-lived.
Okay.
Which takes on a new connotation saying, I am an economist.
Forgive me for totally derailing this. Let me start this again. Matt Stucky, the chief portfolio manager at Northwestern Mutual, writes the following. Weakness in the near-term reaction is likely to be short-lived. And more likely a function of elevated expectations of bullish positioning heading into the print. OK. Matt, welcome to the programme, sir. Why do you think the market is shaking this off? Why is there some comfort with that deceleration?
Well, I think as you're looking at the quarter, it was right down the middle of the fairway, controlling what they control outside of the H20 revenue with China. I think the bigger picture to me, I think, is you look at just the revisions higher in terms of what the addressable market for NVIDIA has been. Specifically, I'm talking about what the hyperscalers are expected to spend in 2026. Just in the second quarter alone, those expectations have risen by another 19% on top of the 20% that we saw in Q1. And so what we're seeing here is just a continued rise in terms of the demand profile for NVIDIA. And so it comes down to, are they able to continue to build enough supply to meet demand? And so a little bit of an inline guidance to inline print as it relates to kind of more the buy side of expectations to me is just a signal that NVIDIA continues to execute well in this market.
So Matt, you still see this as a supply constrained story potentially, and not necessarily a story of weaker demand in the future?
I do. I think if you kind of go around and listen to conference calls, listen to what leaders in AI are talking about, everyone's still talking about how they're short compute capacity, how they could continue to grow if they had more NVIDIA chips to utilize in terms of their data centers. And we expect that to continue to be the case, at least for the next few quarters.
Is it one or the other in terms of an investment strategy that you're either all in on big tech or you're all in on small caps, and I'm saying all in, a little bit tongue-in-cheek, this idea that you're either overweight big tech or you're bullish on small caps, and you got to pick one or the other?
I'm not sure why you can't have both. To hedge out a couple of different outcomes as it relates to the economy. One thing that we know in terms of kind of how small caps can perform is, the increase in expectations that the Federal Reserve will start to ease policy again is good for small caps. I think having some exposure there makes a lot of sense. However, we are a little bit later in an economic cycle. And if you're looking for companies that are higher quality in terms of their margin structure, their balance sheet health, as well as their perceived kind of more insensitivity to the ebbs and flows of the economy, it's in mega cap tech. And so you can hedge both sides of that distribution a little bit just in terms of how stylistically you're building your equity exposure.
It's really interesting that you point that out, Matt, because we've been discussing that all morning, the sort of contradiction in the expectation for rate cuts and the expectation for ongoing resilience. Is that the way that you're squaring that circle? The idea that there is probably a bit of truth to both. You're not sure which one is going to rule out, so just going to hedge at this point?
I think it's a reflection of, the tails of the distribution, I think, are a little bit fatter than maybe what consensus is discussing here. We are still kind of working through, the rise in tariff levels. And if you're looking at kind of where tariff levels sit today, they're not fully reflected yet in terms of kind of what is stated on paper versus what actually is being charged at the ports yet. And so as inventories are replenished, we don't know the ultimate economic outcome of that. Additionally, the state of the labor market, might firm up, it might not. And so having diversification to different styles of what could potentially perform well in a variety of economic backdrops, I think makes sense if you're an investor here.
Speaking of tariffs, and John's been bringing this point up all week, we could potentially get the IEEPA court decision. What do you think can happen to equities if that's struck down, what the president is doing in terms of using IEEPA to set tariff rates?
Well, markets tend to dislike uncertainty in any form. I think if the ruling comes back that this is something that's going to be discontinued on a go-forward basis, there's still other avenues for tariffs to come back into the foray. And I think that's probably where markets will ultimately land in terms of just the ongoing expectation that tariffs in some form, either through the IEEPA or through another kind of function, are going to be higher than where we started this year. Maybe not all the way up to 18-19%, but still quite a bit elevated versus the 2% plus that we were to start 2025.
When it comes to trade policy, China is, of course, still in negotiations with the United States. One of the biggest chips the U.S. is using is chips, NVIDIA. Can we just go back to that? How are you actually thinking about what NVIDIA might be able to sell at some point into Beijing? And does it concern you that some of those profits they're going to have to somehow get back to the U.S. government to bring down the deficit, according to the Treasury Secretary?
Yeah, I mean, I think if you're an investor in NVIDIA here, you kind of think about it as, upside potential versus kind of base case part of the story. In terms of what Jensen was talking about on the call yesterday, they view it as a $50 billion revenue opportunity growing 50% per year. So it's a very large market. And so the ability to penetrate just a fraction of that is upside in my mind as it relates to NVIDIA. And just to put a little finer point on that, NVIDIA got into $54 billion of revenue in the third quarter with the potential for another $5 billion plus of H20 revenue if they can start to get some of these issues resolved in terms of the ability to place product into that market.
Matt Stucky, appreciate catching up with this. Matt Stucky there of Northwestern Mutual Wealth Management. NVIDIA still recovering, down by only 1% at the moment. Futures on the S&P just about green. Dan Ives of Wedbush on the programme earlier said we're going to finish green, I think, on NVIDIA by the end of today.
Based on where it was last night after earnings in after hours, I will just say this is basically green. I mean, can we just say that right now, down 1% is basically green after a 35% gain so far? Well, it's, changing to green.
Okay, I can go with that if you want. I mean, just Is that what you want me to do?
No, I actually just think it's really remarkable how far the stock has come, how high expectations were, and the fact that we're seeing such a muted reaction is considered a win, and certainly something that people are taking and saying, this isn't something to spook you.
Because inline typically would be considered a massive miss over NVIDIA.
Well, especially given the fact that expectations are so high and people always look for massive beats, the fact that they shrug this off indicates people are somewhat comfortable.
Stock is down by 1% in the pre-market. I'm with you. We're on the same page.
It's basically green.
Futures, basically green, unchanged, but basically green. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahira. Hey, Yahira.
Hi, John. As you all said, NVIDIA trimming its losses. Shares are down just 1% in the pre-market now. The chipmaker gave a tepid revenue forecast for the current period, signaling that growth is decelerating after a staggering 2-year boom in AI spending. NVIDIA says it expects sales to be roughly $54 billion in the third quarter, in line with the average estimate on Wall Street. Meanwhile, the Mexican government is planning to increase tariffs on China, fulfilling a long-standing demand from President Trump. Sources telling us here at Bloomberg the tariff hikes are expected for imports including cars and textiles, as Mexico aims to shelter domestic manufacturers from subsidized Chinese competition. And in sports, the fourth day of the U.S. Open wrapping up yesterday with Aryna Sabalenka, Ben Shelton, and Carlos Alcaraz all cruising into the third round in straight sets, while Novak Djokovic battled back to win in 4. Later today, there will be some more big names on the court, including Jannik Sinner, Coco Gauff, and Naomi Osaka. That's your Bloomberg brief. John?
Yahira, thank you. More from Yahira later this hour. Up next on the program, the morning calls, as analysts are staying bullish on NVIDIA, plus John Vinh of Keybanc Capital, after raising his outlook on the tech giant from New York City. You're watching Bloomberg TV.
The godfather of AI, Jensen NVIDIA, continue to dominate this. And I think this is just a further validation tech stocks go higher. And the boom's just starting. I mean, if you look at these numbers, especially when you factor in what China is going to be, I mean, you know, Jensen talked about 50 billion, 50% type growth number. This just shows the next stage of adoption is actually just starting. I think this stock is green today.
Not far off this morning. That was Dan Ives of Wedbush there on NVIDIA. Guess what? Dan, still bullish. The broader market, equity futures on the S&P 500, just about unchanged. Bramo calls this green. On the NASDAQ 100.
Overweight.
Negative by a tenth of 1%. Outperformance on a Russell. There's some green.
Thank you.
Up by a third of 1% so far this morning. That's the price action. Let's get you some morning calls with one stock in focus, NVIDIA. First up, JP Morgan raising its price target on the stock from 170 to 215, noting multiple levers at play to drive upside. Your second call from Truist raising its price target on the stock to 228, focusing on the company's resilient long-term outlook. And your third and final call from Citi raising its price target on NVIDIA to 210, citing continued data center sales upside with or without China. Staying with the stock, CEO Jensen Huang telling investors that opportunities in AI are, quote, immense, even after the company forecast decelerating growth. Mandeep Singh of Bloomberg Intelligence joins us now for more. Mandeep, good morning.
Morning.
Do we need China? Do we need China? Based on some of the commentary, maybe we don't.
And actually, he gave one anecdote yesterday on hyperscale, the 4 hyperscale capex, combined capex, going to $600 billion per year. So right now, based on our calculations, we are close to $400 billion per year from the 4 U.S. hyperscalers. He said it's going to $600 billion, 50% growth, and it's going to sustain. So think of, NVIDIA's exposure to the hyperscalers. The top 2 hyperscalers for them are Microsoft and Meta. They make up almost 40% of the revenue, NVIDIA's revenue. And he's saying that's going to grow 50%. So to my mind, this is like suggesting Microsoft's capex is going to grow at least 50% next year. So will Meta. Amazon and Alphabet are smaller customers for NVIDIA, but clearly this is big. I mean, if he's suggesting capex is going to grow 50%, it's going to have a lot of repercussions for the rest of the market.
I'm old enough to remember when people cared about concentration risk, the idea that the entire NVIDIA revenue depended on the hyperscalers. Is that no longer a concern? It sort of doesn't need China just as long as Microsoft and Google keep spending so much?
Meta. And so
Meta.
Just the two of them. In fact, the four hyperscalers, I said 600 billion. Just the two of them. And by that math, actually that 40% will be a higher number because Google has their own TPUs, Amazon has their own chips they're investing in. So to my mind, the concentration will even increase further. And so we talk about pull forward all day long. To my mind, this is the one risk, the biggest risk. Everything else looked great. The commentary was great. There are a lot of use cases. But then when two of your customers make up, such a big portion of your revenue, you have to ask yourself, what if Meta decides to go with its own chips or Microsoft? And
well,
I think
what
that
if?
risk is there.
I mean, let's talk about next year. What if Mark Zuckerberg suddenly decides it's the year of discipline? What is the risk of that happening in 2026?
And look, if Meta's capex is going up 50%, I bet you it's going to be a drag on a Meta stock. Nobody is factoring in, yes, they guided to over 100 billion, but nobody is factoring in 50% capex increase for Meta and Microsoft. So this clearly was news to me last night, and there's no doubt that they're executing very well ex-China.
Mandy, stay close. I want to bring in John Vinh, the equity research analyst at Keybanc Capital Markets. He raised his price target on NVIDIA to 230 from 215 and keeps an overweight rating on the stock. John joined us now. John, welcome to the programme. Let's just start on China. You heard what Mandy had to say just moments ago. Do you think we are overstating the importance of the story in China?
No, I don't think we are. China, I think in terms of the outcome and the outlook last night, there was a little bit of consternation with a guide with China, without China. Obviously, we felt they were going to exclude it, just given the cross currents that are going down there. So I think the best possible outcome occurred last night where they guided to a clean number excluding China, which could be another $2 to $5 billion in revenues, and numbers are still going up. So I think longer term, China is an important part of the AI pie for NVIDIA. But I think near to medium term, the setup looks very clean because potentially it could be a source of upside in the October quarter.
John, I'm sure you were listening to what Mandeep had to say, and I'm still just thinking about, okay, maybe China doesn't matter as much, at least for future growth, but that means that some of these hyperscalers matter all the more, and this dependence on Mark Zuckerberg's wallet is concerning for some people. Is that concerning for you?
Not in the longer term. Certainly could there be a hiccup where, as you had stated, maybe there could be a moment of discipline in the near to medium term. Maybe he tightens up his CapEx budget for next year. But the AI CapEx spending is driving an acceleration in growth for these major hyperscalers. And they're in an arms race right now. And they know that if they let up, that could be a risk to their long-term business model.
There was a time when people were talking about the need for broadening out for other companies outside of the hyperscalers, outside of the tech space entirely, to adopt artificial intelligence and really gravitate towards some of NVIDIA's products. Are you saying that we don't need to see that? That ultimately the hyperscalers will be the intermediaries for NVIDIA, will be the providers of cloud and some of these systems, and that we won't see a broadening out in terms of clientele for NVIDIA?
No, I do think that you do need some longer term diversifications, and I think you do need some other drivers of AI CapEx growth, right? The next potential legs are going to be sovereign, right? Other countries looking at their AI strategies. It's kind of a small but fastly growing number. And then enterprises, right? Enterprises right now are in kind of a tough environment, but I think every single major enterprise in the world and Fortune 500 company is evaluating and trying to figure out what their AI strategy is. And then lastly, the other emerging driver of growth is potentially robotics, right? Just with the labor shortages globally, we think these are also going to be emerging as diversifying drivers of growth for NVIDIA.
Well, you mentioned sovereigns. I remember when Jensen Huang was in the Gulf alongside the president, very excited about getting into that market. What's the latest on that story besides just the show of force he had with the administration?
I think the administration is still trying to figure out exactly what their sovereign strategy is, right? Obviously, we showed what our cards were in respect to China. I don't know if that's the right strategy. I think the right strategy for countries like China and the rest of the world is you want them to use our technology. You want the US AI platform to be the platform of choice, because if you take the policy of just restricting exports to countries that you're concerned about, competitive risk, these countries are ultimately going to figure out their own strategy or rely on other sources of supply, potentially from our competitors.
Given that thinking, do you think this government will allow the higher end chips to go to Beijing?
Not in the near term, right? I think it's pretty clear where we're drawing the line. We're drawing the line at H20s. We believe that NVIDIA is also developing and working on another compliance SKU that doesn't use high bandwidth memory. So I think in the near term, I don't think we're going to allow higher performance GPUs to China.
John, appreciate your time. Thanks for breaking it down. John Vinh there of Keybanc. The latest on NVIDIA, that stock is negative by about 1% so far this morning. Mandeep, I just want to finish with you on China and this revenue share with the White House. I guess what you say when the cameras are rolling in the White House is different to what you say on an earnings call, because I didn't get a clear read on what's happening with that revenue whatsoever yesterday. Did you?
No, I did not. And look, they're saying the administration will have to give a clear directive in terms of what they are allowed to sell, and also the revenue sharing, the 15%. So from that perspective, look, the guide is obviously ex-China, and they are doing very well when it comes to managing expectations. But there is no doubt when you look at the large language model companies, if your customers are able to train your models on someone else's chip, why would they come back to NVIDIA? And the delay that's going on, 2-3 quarter delay, those companies are not stopping their training process or their inferencing process. They have to find compute. And so I'm curious to know, how are the Chinese large language model companies right now managing their compute? What sort of chips are they leaning in on? And to my mind, the more the delay, it'll be harder for NVIDIA to capture that share.
We've introduced a lot of political risk into this name this year alone.
Yeah, and this is really the reason why you heard Jensen Huang say we just have to keep advocating that the sensibility of and the importance of American tech companies to be able to lead and win the race. They're making a very political argument. What did we hear from Dan Ives? 10% politician and 90% CEO? Seems to be what we are witnessing here too.
Feels that way big time. Maybe the other way around.
Yeah, that's what I think. I think it's the other way around.
Like 90% politician at the moment.
Kinda.
Up next on the programme, we've got some economic data for you. Citi saying this: payroll growth averaging just 35k a month will keep Fed officials focused on downside risk to employment, continuing jobless claims in focus. Nela Richardson of ADP on the other side. The opening bow is about 60 minutes away. The data is about 25 seconds away. So let's focus on the data and start with the scores. Equity futures on the S&P 500 negative by not even 1/10%, down about 1/10 on the Nasdaq 100, positive on the Russell, up 1/3% on the small caps. Getting very excited about rate cuts in our future. That's going to depend on the economic data. Ahead of the data, bond yields are a little bit lower at the long end, down by 2 basis points, 490 on 30s, and yields are higher at the front end by 2 basis points to about 363. Let's get you that economic data. Let's cross over to Mike McKee. Good morning, Mike.
Good morning, John. We're waiting for the jobless claims numbers to drop, so I'll tell you that GDP in the first revision rises to 3.3% from the prior forecast of prior number of 3%. Now, here are claims: 229, significantly lower than last week's 234, and below the 230 that was forecast, although that's pretty close. 1,954,000 continuing claims, up from or down a little bit, actually, from 1,961. The previous number was 1,972. So a little bit of a pullback there in the number of people who hadn't gotten jobs. So jobless claims, labor market looks status quo at the present time. Going back to GDP at this point, what we're looking at is a 1.6% increase in personal consumption, consumer spending. That's up from 1.4% in the initial report. The price index is on a quarterly basis unchanged, 2.5% on a core basis and 2% on a year-over-year basis. I'll look deeper into these numbers while you tell us if anybody is paying attention on Wall Street.
Mike, thank you, sir. No shocker here, no drama. So claims look rock solid, and in the bond market, yields are a little bit higher at the front end of the curve, and in the FX market, the dollar's just a little bit stronger. To discuss the numbers, and then we'll come back to Mike McKee and get some details in just a moment, we'd like to bring in Nela Richardson, the chief economist over at ADP. Nela, good morning.
Good morning.
If you took some time off, not that you ever do, but if you did, and you didn't know any of the economic data, and I just showed you jobless claims, would you have a decent read on the labour market right now?
Yes, I would think it was pretty strong. But if I unpacked it a little bit, and I haven't taken a lot of time off, actually, so I've been unpacking quite a bit. I actually identify 4 crosswalks between macro trends that are big in the making and also the very granular real-time data that we're seeing. And the first one is the consumer. That consumer spending, which we're seeing picked up in the GDP numbers, has been a resilient driver of the labor market as well. So where you see strength in the consumer, you're seeing strength in the jobs market, namely leisure and hospitality, and there's some trade and transportation that has been strong. But then you see this other macro theme of uncertainty, and I think that's depressing some job gains in professional services. So there's a lot going on between the big picture macro trends and the smaller granular real-time hiring that businesses are doing right now.
How much is there stealth firing or sort of attrition plans that are in place that don't make it some of the overall numbers as necessarily job losses in the traditional way?
You know, this is a super, and I'm glad you asked me this question because it's a super complex question. Because what we're seeing on the part of the employer may not be demand driven. First of all, we had this great big resignation in 2022, and young people are supposed to turn over. They're supposed to leave these jobs, they're staying put. And so there's a little bit less hiring because people are staying put. And then you have the effect of AI. There's been new research from Stanford that was out using ADP data. A paper was released yesterday saying that in AI-exposed fields like software developers or customer service reps, you are seeing an impact in early career. So you can't look at the macro, you have to dig beneath the surface to see all the things that are different about this labor market, making it very challenging to predict its next moves.
But do you get a sense of whether it is weakening in a way that would justify some sort of Fed move or that would require some sort of policy adjustment? Or is it just transforming? Is it just a structural shift that has nothing to do with policy, frankly? It has to do everything with technology.
Yes and yes. And that's what makes it so hard. Yes, it is weakening. We are seeing a slowdown in hiring momentum. It's a slowdown from the beginning of the year. It's a slowdown from last year. Some of that is what Chair Powell said in his speech, that we're seeing lower supply, lower demand, but still some equilibrium that gives us a pretty good unemployment rate. But yes, it is structural. We're seeing aging demographics really cut into labor and these nascent technologies affecting early career in real time. So yes and yes, it's both, and that's why you can't predict it. You're going to see companies be hesitant and slow down their hiring because of macro trends that have nothing to do with their customer base. And then they're going to come back in the market and hire when they need to. And so we won't know if a 1-month slowdown is indicative of a really weakening labor market or just some hesitancy. So we have to look at a couple more months to get that trend right.
The OceanFirst financial CEO was just on. He was saying with his commercial clients, they're not hiring as much because of AI. You were at Jackson Hole. The theme was labor and transition, yet you said no one presented a paper on artificial intelligence. Is the Fed too late to really understanding what's going on?
You know, it's so new, and it's a great question. These themes, these papers in general, I mean, economists have a lot of good attributes. Being on track all the time in the micro data is not always one of them. So some of them, I know, it's a big reveal. So these papers are really important. They had big themes like fertility and population growth and mobility.
But what's happening right in front of them right now?
But AI is harder because you have to have granular data. And that's why this paper that I mentioned from Stanford, looking at ADP's millions of job titles, you actually see the effect AI is happening. So for employers, there are some big investments in AI. Some of that investment will augment career. So for later career, more tenured workers, AI is seen to boost productivity. And those investments are being made by companies. But for jobs that are easily automated, you might see a transition of those workers, and you're already seeing that transition happening. I think it's going to be short term. I think labor shifts to where the puck is heading when it comes to productivity, but we're in the midst of that transformation right now. And yes, it's not really being picked up in economic models.
If you're just tuning in, welcome to the programme. Just moments ago, some economic data on GDP and on jobless claims. Mike McKee standing by, who has a little bit more. Mike, you've had a second look. What do you see?
Well, we can see what's under the hood here, and the basic reason we saw a rise in GDP in the first revision for the second quarter is personal consumption rose to 1.6% from 1.4%, and business investment significantly increased. Non-residential fixed investment up 5.7%. It was 1.9% in the original print. Exports were down 1.3%, a little bit less than they were in the initial print, and imports were down 29.8%, basically unchanged in terms of overall trade numbers. But we did see that shift from the first quarter to second quarter, where imports were huge in the first quarter and dropped off negative, actually, in the second quarter. And then finally, we had the federal government spending down 4.7% and non-defense spending down 12.5%. So a big drop there in what the government was spending. And the bottom line, and Nela will appreciate this, I guess, as one of those economists who looks at the micro and macro numbers, is that real final sales to domestic purchasers were up 1.6%, over 1.1% in the first initial print. Overall, real final sales 6.8% from 6.3%. So we have a little bit stronger GDP than we thought we had in the second quarter. Of course, now it's all about quarter three.
Mike McKee, just before you go, it feels like in April there was some paralysis in the economy. A lot of people held back trying to work out what was happening with policy. Are you getting a clean read on anything to do with just things bouncing back, that maybe we will see that reacceleration as the year progresses and people re-engage with the economy?
I think we're too far away from the second quarter numbers to say that this revision has much bearing on what's going to happen. The good news was that businesses were spending in the second quarter, and that's been what everybody's watching. Were they going to hold off or not? Consumer spending continues at a slower pace than it had, but they're still hanging in there. So where do we go from here? Everybody's been waiting to see what effect the tariffs would have, and this is about the time when we're going to start seeing that.
Mike McKee, appreciate it. Mike, thank you, sir. As always, Mike on the data there. Nela's still with us. Nela, we wanted a word from you on the Federal Reserve. September in some ways feels like an easy call now. They're going to cut rates. How would you set things up for people for September and beyond into 26 of the Federal Reserve?
I think it's really helpful to look at how the Fed has moved historically, which is in small bites, moderated over a long time frame. That may not be the way that they can act now because there's so many moving parts of this economy. Whether you think that tariffs are a one-time price increase or have ripple effects, the fact is the lags between monetary policy and the lags between what's going on in the economy, they might miss each other. And so I expect a Fed that will be constantly data-driven and may have to pause to recalibrate where the economy is moving. I don't think it's going to be clear to them even when they start acting.
This is something we were talking about earlier on this morning, that after September, what was the phrase, our favourite phrase?
Hawkish cut.
Hawkish cut.
Yep, that's exactly what people are expecting.
Many people believe that you get that first cut and it's the start of something deeper. Other people believe that in September they might cut interest rates, but then open the door to a much more nuanced conversation about the rest of the year.
Yeah, the idea of a dual mandate in conflict and how that's going to cause them to be a lot more cautious. And the fact that we haven't really seen the inflationary ramifications and just how this Fed will handle and potentially look through or not some of the inflation related to tariffs and beyond.
Nela, it's good to see you. Always is. Thanks for dropping by. Nela Richardson there of ADP. Some breaking news just moments ago. It comes from Fox Business. Allow me to share it with you. That the CEO, Jensen Huang, tells them he's in talks with the president and the administration about selling his better Blackwell AI chip to China, and he's also willing to give the US government a cut of those sales. Plus, he wants US tech, of course, to be like the US dollar, the global standard. But the more important factor here is the Blackwell chip. Now, what isn't clear here is whether he's talking about the less advanced Blackwell chip, but the more advanced H20, or whether he's actually talking about the tip-top chip that comes from this company or not?
Yeah, I think that's a nuance we need to understand from either NVIDIA or really the Trump administration. What export license are they willing to give? The president had signaled he is willing to make a deal when it comes to Blackwell. He's basically saying, we'll take 30-50% of it in order to do this. Another interventionist approach from this White House and a real pay-to-play kind of opportunity for NVIDIA. And likely, given how the president explained the 15-20% deal that was cut for those H20s, it looks like this is something NVIDIA would be game for, even though on their call, the CFO says it might open them up to litigation.
The more time Jensen Huang spends with President Trump, the more the shares are going to rally. And I think that really speaks to the political moment we're in and the idea that as long as he can get his story out, that the more that the U.S. technology is the standard, that's going to be the better for the United States, the more NVIDIA is going to really benefit.
We need some more clarity on this story. Let's put it that way. But I can tell you the stock's recovering. We're down now just 0.1% in the pre-market.
Basically green, 100%.
Stay tuned. Let's give you an update on stories worldwide with your Bloomberg Brief. Back with us, here's Yahira. Hey, Yahira.
Hi, John. White House trade advisor Peter Navarro is pressuring India to halt its purchases of Russian oil. Navarro, here on Bloomberg, accused New Delhi of funding the Kremlin's campaign in Ukraine and calling the conflict Modi's war. The U.S. doubled tariffs on India to 50% this week in an effort to secure concessions on trade and pressure Russia. Meanwhile, Brazilian President Lula da Silva's popularity is waning this month, suggesting the momentum he gained from his trade fight with President Trump may be over. Lula's approval fell to 48%, down 2 points from July. His disapproval rating rose to 51%. And shares of Victoria's Secret are rising 5.5% in the pre-market. The company raised its outlook after strong quarterly sales, a sign the new CEO's turnaround plan is taking hold. The company expects full-year revenue to reach up to $6.4 billion, which includes an estimated tariff impact of about $100 million. That is double the prior projection. That's your Bloomberg Brief. John?
Yahira, thank you. Appreciate it. Up next, Jim Tierney of AllianceBernstein as markets shake off NVIDIA earnings, and NVIDIA shakes off NVIDIA earnings too, apparently. Plus, Danny Berger with your morning movers. Bath & Body Works warning of a multi-million-dollar tariff hit. That stock is down by 3.6%.
The NVIDIA report kind of like threaded the needle, right? It was strong enough that you didn't get kind of a liquidation in those long positions, but it wasn't so strong that it disrupted the rotation that's been going on for the last couple of weeks. The market right now is to some degree in one big trade, right? And that trade is long growth, long large cap, long the AI thematic, right? And everything else has sort of been ignored to some degree.
Lisa, as always, ahead of it. It was green before it was green.
It was basically green, and now it's getting close, so there we go.
NVIDIA getting closer and closer to turning positive. That was Stuart Kaiser of Citi. The broader market's doing okay. Equity futures just about positive on the S&P 500 as we count you down to the opening bell. That opening bell's about 42 minutes away. With your morning movers is Danny Berger. Hey, Danny.
Hey, John. Even more retailers reporting earnings this morning. Some really tough set of numbers. Hormel Foods, they make all of the deli meats you find in grocery stores. A miss and a cut to their guidance. The CEO saying that the issue is higher prices, really feeling the strain of that in the current quarter, and they expect it to bleed into the next. They also talked about trying to raise some of their prices in order to offset some of the profitability hit. Those shares down over 10.5%. Bath and Body Works, those shares down 5.2%. For them, it was their first miss since 2020. It was a tariff impact that they are citing. $40 million will be the hit to them for tariffs, contrasting with some of the other retailers we've been hearing from. And we also heard from Urban Outfitters, another retailer with a poor set of numbers. 1.7% is the decline that we're seeing for them pre-profit. It was an outlook that missed expectations and a downgrade to their gross margins. They say the tariff hit will be 75 basis points. Previously, they saw 20 at issue, and the new thing to incorporate for them was the 50% tariff from India. They say that they're going to try to negotiate with vendors, rework some of their shipping routes, and do what they called gentle price raises to try to offset that. John.
Danny, thank you. That's a new one. Gentle price raises over at that retailer. Gentle.
The way that people are going to message this is just incredible.
First move, though, you saw it, right?
Yeah.
First move, negotiate with suppliers.
Yeah.
This is why it takes time.
Well, I'm looking right now at Bath & Body Works, expecting to see this hit, and yet they say that they've been actively reshoring to the United States, and over 80% of the products are made in the United States. So it just raises this question of how you identify made in the United States, how they identify the tariff hit, and how much gentle pricing increases we're going to see.
Also, potentially, maybe just consumers are not interested in your products anymore, but a really easy way to guide that is just, we're dealing with tariffs and all that uncertainty.
Let's stay with the markets. We're joined now by Jim Tierney, the Chief Investment Officer of Concentrated US Growth at AllianceBernstein. Jim Tierney joins us now for more. Jim, good morning.
Good morning.
Good to see you, sir. We've got comfortable with these NVIDIA earnings after about 12 hours and change. How comfortable should we be with these numbers this morning?
I think we should be very comfortable. When you look at the numbers, the revenues were essentially in line for the quarter. Next quarter met expectations, excluding China, and China could be some upside. And importantly, on the expense side, things are well controlled. We're going to see margin increases as we go into the third quarter. So all in, very positive.
Does this remind you of Apple in the days where people would line up to bet against this stock and they were always wrong and Apple kept going higher? I feel like that's starting to happen with NVIDIA now, that people are just... They've missed out on this massive boom over the last few years, and a lot of people are lining up to say, this is it, it's over. Does it feel the same way?
It does, and one of the things that I think people are missing here a little bit is the absolute growth percentages. We're talking 50% plus growth. Those are spectacular numbers, and if it's 45 and a quarter, that's okay too. And you look at what Jensen laid out in terms of $3 or $4 trillion of spending out 5 years from now versus where we are today. Those are massive growth rates, and we're not seeing that anywhere in the U.S. economy or the global economy.
But the issue isn't whether or not it's growing quickly. The issue is that it's been priced in and then some, and it's a $4.4 trillion stock. The issue is where valuations have gone to, and people have already gotten ahead of that. Does it worry you that the majority of that growth is set to come from just a small handful of names that could turn off the spigot if things warranted it?
I think there are two issues there. One is the valuation. And when you look at NVIDIA off of $7 of earnings in calendar 26, it's about 25 or 26 times earnings. I don't consider that expensive for a company that's growing that fast. So I'm not worried about NVIDIA's valuation. If you look at what's driving the market, and is it a very small group of companies? Absolutely. That's very concerning. Because if for some reason CapEx spending doesn't hit that $3 or $4 trillion that is talked about, we may have a little bit of an air pocket. But when you look at the arms race that's going on right now within AI spending, there is no end in sight.
Well, it's international. And this is a reason why it's sort of how much is Jensen Huang a diplomat and how much is he a CEO? Because ultimately it depends on the sovereign buying of some of these chips, as well as China, the sort of elephant in the room, and how much they will be able to adopt U.S. technology. How much do you get comfort and want to press buy, as soon as you see Jensen Huang visiting the president again?
I don't think I get caught up in that as much as some others might. I think when I look at the drivers of demand over time, there are multiple buyers. And it's not just the hyperscalers and not just the sovereigns. It is going to spread out to enterprise over time. And we haven't even talked about robots, which robotics is a next leg of growth that people shouldn't sleep on.
When do you think you're going to see a catalyst where the risk is no longer worth taking when it comes to AI?
You'd have to see companies missing earnings materially, and we didn't see that. Where you saw the biggest beat was from the tech complex coming out of the second quarter. So the earnings are very strong.
So just go back to Lisa's point. When it comes to China, you think it's all noise when it comes to how basically what Jensen Huang does in China and NVIDIA's growth there is really dependent on what kind of policy comes out of the White House?
I don't think it's noise, and that's a real part of their business. So no one wants to see that go away. But at the same time, there are other drivers that are filling in that divot. And to be able to cover that $2 to $5 billion divot is pretty spectacular.
Jim, can we talk about the potential, big picture here, the potential for some political constraints in the years to come? The price of electricity for consumers, the prospect of job losses, the kind of pushback we could see from politicians at both the state, local and federal level going forward from here. How are you thinking about those potential developments in the years to come?
Certainly a lot of different issues there. Power is a constraint, and when you look at NVIDIA's revenues and sales, they probably could have done better if there was more power widely available in the U.S. In terms of will the hyperscalers be stealing that power from the U.S. consumer? That obviously can't happen, and we need to solve that problem. When you look at job loss, I think that's a reality. We've had creative destruction in our country for decades. And you look at Microsoft. Microsoft is a great example of a company that is holding headcount down by using technology, and therefore margins keep rising. I love that. I mean, that's exciting when you can see a company do that.
I'm pulling you away from your seat just a little bit, but I just wonder how tolerant these politicians will be of creative destruction in 25 and beyond, given developments politically down in Washington and beyond.
I think the goal is to bring more manufacturing back to the U.S. and fill that hole. But you would have made the exact same argument 100 years ago with farmers. And the farming population is pretty darn small today, and people have found other jobs.
Jim,
so something to worry about, but I think solvable.
I'm always worried. I hope we can solve it. Anyway, Jim, it's good to see you. Thanks for dropping by. Thank you, sir. Jim Tierney there of AllianceBernstein. I know you're thinking about a similar issue as well. The price of electricity. Keep going back to it. It's getting higher and higher. It's getting more and more expensive.
So that caters to the middle and older demographics, and the younger demographics are going to get hit by some of the job losses that you've seen in terms of artificial intelligence entry level for software producers. I'll just give you this anecdote. I've got two sons. They're 3 years apart. My older one worried about getting a job. My younger one worried about killer robots. It kind of sums up where we're at.
Well, also politically, it already is infiltrating Washington, D.C., the concern about this. It's kind of weird when you have Barack Obama and Steve Bannon lining up when it comes to AI and the concern that it could do in terms of destruction on white-collar jobs.
But what did you say when he started to worry about killer robots?
Well, he then started showing me pictures. He's like, they've built the torso to the killer robot. And I'm like, get off TikTok. Just stop. Whatever you're on.
Is that where he's seeing this stuff?
It's YouTube Reels. I don't know. It's social media.
Be careful. That's the Chinese
exactly.
algorithm.
And they're
trying to get the kids to fear AI so that we lose the race in the AI race here in the United States. Is that what's happening?
I think he's worried about a killer robot. I don't think it has to do with AI race. I think that is actually a real one. Yeah, but maybe.
Like,
you think so?
Yes.
But this is YouTube Reels. Okay,
I don't know.
That's going to be...
I don't even know.
You're doing great.
I'm counting down the seconds.
I know you are.
I've got to go.
Please.
Coming up tomorrow, Brian Nick of New Edge Wealth, Kelly Kaminsky of Alpha Simplex, Dana Telsey of Telsey Advisory Group, Zach Griffiths of Credit Sites. From New York City, I'm joking. I was joking. Or was
sort
I?
of.
Or what's kinda? A little bit. This was Bloomberg Surveillance. You're watching Bloomberg TV.